All right. I think we are live. All right. Testing. Hey guys. How's everybody doing? I think, let's see. Yep. Chat should be on. Guys, if you can hear me, just type a Y in the chat room. What's up, Kevin?
Test. How we sounded?
Yeah, how's the audio, guys? Can you hear us both?
Test.
Sweet. Thanks, guys. All right. Tony, you want to switch us over to the live camera? Boom. I think we're good. What's going on, guys? So we are testing a new setup here. We've got this new studio, and this is our first live masterclass where we're using a camera like this, and then we've got our new screen, and then we got Tony, our producer, off camera there, and we got Travis DeVitt, obviously. So hopefully we have no tech issues.
It's always the X factor.
Yeah. Fingers crossed that nothing screws up really bad. Sweet. Well, we'll give everybody about another minute to get in. I can see everybody's kind of flooding in right now. So thanks for being here with us, guys.
Yeah, we're excited.
Where's everybody from? Where are you guys at in the world? Sweet. Zane, Colorado.
Ooh,
France.
Love the mountains.
Yep.
France.
Bulgaria, Nigeria, Vancouver.
Ooh, Vancouver, another one of my favorite cities.
Yeah, that's a dope town. We like going to ski in Whistler.
Yeah.
Phoenix, South Dakota, Russia, South Africa, San Diego, California, Philippines. Sweet. Slovakia, New Zealand, Panama.
New Zealand.
Steven in Austin. What's up, buddy?
Steven.
Halifax, Sweden. Man, we've got a really international crowd.
It's awesome. I love that.
Yeah, dude. Nashville. So I'm kind of curious how many of you guys are trading or invested in stocks. If you have any stock positions, meaning like a 401k with a passive portfolio, or if you trade stocks, or if you ever have, type a number 1 in the room. If you don't currently own any public stocks, could be US, could be Europe, Asia, whatever. If you own nothing or you've never traded stocks, type a number 2 in the room. Kind of curious. Sweet. Looks about, I'd say like 70-30.
In favor of people who have traded stocks?
Yeah. Most people, it looks like you guys have some kind of stock positions. So that's cool.
Awesome.
And for those of you that don't, I think this is going to be a really good class for you because Travis is going to talk about why it's so important to consider that as a part of your wealth building strategy. You know, a lot of you guys know me from the crypto space, but what you might not know is actually about 40% of my net worth is in the public equity markets, meaning the stock market. So, yeah, how's the volume, guys? How's the audio?
Check.
Do we both sound pretty good? Too loud, too soft? This is our first time doing this, so you guys might need to help us get this stuff dialed in. Cool. Yeah, if it's breaking up, looks like for most people it's good. Demon, anybody else, if the audio is either breaking up a lot or if it's really low, it could be your download speeds or if you're on Wi-Fi.
We're going to have a recorded version too, right?
Yeah.
In case they need to go back and watch it later.
Yeah. So if your internet cuts out or something, should all this tech stuff work, we'll have a recording. So yeah, we've got these fancy new mics and we've got multiple cameras, but we could only get one working today. So that's what we're working with.
You guys, I have a face for radio anyway.
You've got the hair for TV though. Sweet. All right, T, are we good? All right, let's go ahead and jump into it, guys. So again, thanks for being here. My name's Chris Dunn. Got my good buddy and stock trading professional Travis DeVitt with us. And today we're going to be talking about Travis's hedge fund playbook for individual investors. So yeah, let's just go ahead and jump right into it. What do you think?
Yeah, let's do it.
Cool.
I'm excited.
All right, let's see if we can get this. T, I'm going to steal the mouse from you. So just a quick risk disclaimer. We're not trading advisors. This isn't investment advice. And the thing I really like to say every time we do one of these classes is, guys, no matter what market you're looking at, don't invest or trade with money that you need to pay bills, right? It's called risk capital for a reason. And if you go into the markets and you try to use a bunch of leverage and you trade emotionally or you put money at risk that you really don't know what you're doing, that's how people get wiped out. And so the first thing that we really want to teach you guys is responsible investing. And so that's really kind of the gist of this disclaimer is like, just be responsible and take full ownership of whatever decisions you make in the markets. And so this is what we're going to cover today. So like I said, this is kind of our first time with this type of setup. We're going to take about an hour, 60 to 90 minutes, where Travis is just going to do a deep dive and talk about his playbook, which is basically how he invested at $1 billion hedge fund. You know, there's not a lot of guys with his level of expertise or skill level that are able or willing to share this kind of information. So I'm really excited to be able to help co-host this with him. And I know you're going to get a lot of value out of it. So go ahead and turn off, Facebook or email or whatever. I think it's going to really benefit you to just stay honed in for the next hour or hour and a half. And then after that, we're going to be opening up a couple of spots in our wealth building community. So at the end of this, I'll tell you what that's about, who it's for, and most importantly, who it's not for. We're pretty picky about who we like to have in our community. And then we're going to take some time to do some Q&A. So if you guys have any questions or anything that you want to review after we go through all of Travis's information, you guys will have time for that. So we're going to go ahead and turn off the chat while Travis is doing most of the bulk of the training so we can get to it. But feel free to write down questions as we're going through this. And then at the end, feel free and I'll help him get through all the questions.
Awesome.
Sounds good. So before we move on though, I just want to do one more quick audio and visual check. If you can hear me clearly and see us right here, and Trav, do a quick audio check as well.
Check.
Yeah. If that sounds good, if everything looks good, just throw a Y in the chat room there and we'll go ahead and get rolling. All right. Awesome. Thanks a lot, guys. So with that said, before we jump into, I guess, the slides, let's do just a little bit of an intro.
Sure.
For anybody that doesn't know me, I'll just do a quick intro for myself and then I'll introduce you guys to Travis. My name's Chris Dunn. I'm the founder of the Skill Incubator. I've been obsessed with financial markets ever since I did a trading competition in high school, over 15 years ago. And I got into the futures markets during high school and did everything from day trading, swing trading, designing automated systems, discretionary systems. And then over the years, I got frustrated with the state of the financial markets because I thought they were becoming way overly competitive with high frequency algorithms. And in 2013, after ignoring Bitcoin for a couple of years, I went all in on Bitcoin and have been investing and trading in that space ever since then. And so obviously did really well in those markets and have been doing my best with the Skill Incubator to pull people in that have expertise in different ways that can help people grow their income and build wealth in today's economy, right? Because things are changing so quick with education and the way the financial markets work. And I kind of geek out on that stuff. And obviously I like doing whatever I can to build wealth for myself. And so I know a lot of you guys have probably watched my YouTube videos about crypto and Bitcoin. But what you might not know is that probably 40 to 45% of my net worth is actually in the stock market, either in a passive portfolio or an active portfolio, or kind of a mixture of the two. And Travis is one of the smartest guys that I know, if not the smartest guy I know in the stock market. He's got a track record that is really, really hard to come by. And Travis, where do we meet? We met in the angel investing space, right?
Yeah. We actually met through a group that invests private capital in startups. And Chris and I were probably two of the younger guys in the room, but we just immediately connected over stocks and financial markets. And ever since then, we've been fast friends and partners. So
yeah. So I've been twisting his arm for a few years, trying to get him on board with the Skill Incubator, and he's been with us for like 6 months now, and has just been doing an awesome job. And so we want to do kind of a live class today to show you exactly what he does. And so, Trav, man, I'll pass it over to you, and let's just do a little bit of an intro and tell people who you are and what your background is.
Yeah. So for those of you who don't know me, I'm Travis DeWitt, and I'm a professional investor. That's been my background for more than the last 15 years or so. And, I got a finance degree from the University of Texas at Austin. And from there, I was just immediately fascinated with the stock market. I started trading when I was in college, made a lot of stupid mistakes, eventually figured it out. And then right after college, I joined a hedge fund called Stadium Capital Management, which was a long short equity hedge fund managing about $500 million worth of capital, headquartered in Oregon and Connecticut. And, there I did a lot of, learning about deep research in stocks and in businesses. And then after Stadium, I went to a fund here in Austin called Teton Capital Partners, which actually files its investments under Ancient Art LP. And when I joined, it was a small upstart fund managing about $150 million worth of capital. And in about 7 or 8 years of working there, we grew that from about $150 million to over $1 billion under management today. And, we were consistently ranked among, the top 100 hedge funds globally for, our returns. So a lot of that capital growth, in fact, most of the capital growth actually came from our strong returns, not from raising new capital. So it was a really great experience. We did a lot of really interesting things, mostly in stocks, but also in other areas like distressed. We occasionally did macro trades. We even had a CDS trade one time. So that was interesting. But yeah, we just really got deep into finding really undervalued companies, finding things that the market was missing, and really profiting and being opportunistic about finding really great investments, not only domestically but also internationally. We had a big international focus, so we spent a lot of time looking at European and Asian stocks as well.
And so what was your role? And I guess for anybody that doesn't know, what is a hedge fund, and what did you do at these hedge funds?
Yeah, a lot of mystique behind hedge funds, right? But there's so many out there now. It's hard to really generalize about hedge funds, but all a hedge fund really is an investment partnership. And it's different from something like an ETF or a mutual fund in that, the hedge funds typically actively manage money. They make picks of specific investments, and their incentives are more aligned with their LPs or their investors. The goal is the hedge funds really only get paid the big bucks if they can deliver great returns to their investors. So unlike a mutual fund, which just charges a percentage of assets, a hedge fund usually makes most of its money on its performance fee. So you have to be performing well to make good money in the hedge fund space. Hedge funds became really popular in the mid 90s because of that incentive alignment, and a lot of famous fund managers that did really well with that structure of investment partnership. And that's been termed a hedge fund. And, today there's a lot more hedge funds than there used to be. So there's a lot of pretenders now, but there still are a lot of really great elite investors running hedge funds.
Nice. And so what was your role at a hedge fund? Like, what would a typical day look like, and what kind of trades were you taking? And
so I started out in the first hedge fund as an analyst, just learning. We had a couple portfolio managers, and so they would go tell me what companies and stocks to go look at, and very deep research, like I said. So spending time going through financials, press releases, putting together financial models, going and talking to management teams, going to conferences, talking to suppliers and customers, and just figuring out, taking that mosaic of information and figuring out what stocks were undervalued and which ones weren't, which ones had potential, and that kind of thing. As I moved over to Teton, I actually became more involved in actually generating new ideas, just scouring the globe, looking for new investment ideas. What's underpriced? What is nobody looking at? What has interesting upside? And so became much more of a portfolio manager, although I think my official title was senior analyst. But, really got to do everything from generating the ideas to working on the ideas, meeting with the managers of those companies, and then ultimately making those investments and monitoring those investments. So really just totally involved in the investment process from start to finish.
It's a hell of an experience, man, especially being able to be at one of the few funds that actually outperforms the market year after year.
Yeah, I'm very lucky and very, grateful for that experience.
So why did you leave?
Good question. I mean, honestly, it was very lucrative and I actually enjoyed the work a lot. But at the end of the day, I had this growing feeling that, being part of the investing world on the professional level wasn't really creating anything new in the world. Mm-hmm. Ultimately, our product that we're putting out is we're making rich people richer, in the investing world. And
because you have to be accredited to even be in a hedge fund like that, right?
So. That's right. It's only accredited investors and institutional investors that typically invest in hedge funds.
Yeah.
So, it just over time became kind of a feeling that I wanted to go out into the world and create things rather than just managing money for, other rich people. So I left the hedge fund world and I actually got into, helped a buddy build a startup. And so we took that from a few employees to over 150 employees and, venture funded Series B, just doing really well, and did that for 4 years and was investing in private companies as well. So not only helping operate startups, but investing capital, and doing a lot of that on the side. And now, over the last year or so, as we became business partners, really trying to take what I've learned in the investing world and start giving that to individual investors who have never really had access to that kind of information, those kind of tools.
Yeah. And that's why I'm so happy to have you here, man. And I'm excited for you guys that you're going to get to hear all this stuff. So, Tony, why don't we switch over to full screen, and then Trav, I'll let you take it away, man. And just go for it.
Cool. How are we looking? Do we have control over the slides?
Yeah, let me click right there. Should be good to go.
Awesome. Yeah, so just real quick, we'll fly through this, but the things that I want to cover in this class are going to be, first of all, I'm going to talk a little bit about why the stock market matters, why stocks are such an important asset class, and also, unfortunately, most investors, despite the stock market being a place of great opportunity, can't actually beat the return of the overall market. And we'll talk about why that is. But that's also true of a lot of hedge funds these days. A lot of professional investors can't even beat the market. And so we'll talk about some of the reasons why and how you can kind of differentiate yourself in that way. We're going to talk about how you can actually use the ever-present fear and greed in the market to actually, make market-beating returns. And I'm going to use a lot of real examples of investments that I've made over the years so that you can really get tangible examples of how these principles go to work for you. And I'll talk about the 3 keys to making a great stock investment, which I think will be really useful for all of you. A lot of practical application of the ideas about how you make money in the stock market.
Sweet.
Cool.
I think it's the down button.
Okay, cool. So first of all, let's talk about the opportunity in stocks. There was a study done called the rate of return on everything. It was like these academics, 4 or 5 academics that looked at data from 1870 through 2015 on a bunch of the major asset classes. So, fixed income, government bonds, stocks, real estate, commodities, all of the major ones that have data going back a significant amount of time. And what they found was there were 2 asset classes that outperformed pretty much everything. And those asset classes were stocks and real estate. So you can see here in the chart, this is true pretty much across all major countries. Stocks and housing have both outperformed other asset classes and have produced inflation-beating returns in most countries over time. Stocks have produced about a 7 to 9% annual average return in most countries, which, with inflation levels in developed countries of about 3%, gives you about a 5% a year spread over inflation. And so stocks as an asset class have done really well. And that's why, so many investors are told to put significant amounts of their retirements and 401ks into stocks because they have historically, performed very well. Now, that's not to say that stocks are up every single year as an asset class. But, for instance, in the US, the S&P 500 index, which is an index of about 500 companies, has been up, I think, about 75 to 80% of the time annually. So about 3 out of every 4 years, the S&P 500 is up. And again, it averages a compound annual average return of about 8% a year historically. So, that gives you the power to beat inflation and grow your wealth over time. So that's why, stocks, it's one of the reasons why stocks are such an important asset class. So that 8% annual average is pretty good, right? In 8%, I actually show this compounding table here to show you what would happen if, over a 30-year period, you compound at 8%. If you compounded 8%, you start with $1,000 and you compound at 8% a year for 30 years, you end up with a total ending portfolio value of about $10,000. So about 10x your initial capital if you compounded 8% a year for 30 years. That's the power of compound interest. We're not going to go too in depth on compounding here, but it's a very important concept in finance. Hopefully you spent some time understanding it. So that's that 8%. But what happens if you double your return? If you double your average annual return from 8% to 16%, you don't actually double your ending portfolio value after 30 years. You actually multiply that by about 8.5x. So your $1,000 turns into $85,000 when you're compounding at 16%. And if you go even higher than that, if you were to say deliver a 24% compound annual return, you would have 63 times what you would have had in the 8% example. So you would have $634,000 at the end of 30 years, starting with $1,000 if you compounded at 24%. So compounding at really high rates of return year after year produces massive amounts of wealth. And that's really what happened at our hedge fund. We were able to compound annual returns above 20% net of fees for our investors. So you can imagine, even after a short period like a decade, our investors made significant multiples of their initial capital by us being able to generate those high returns year in, year out.
So this is really interesting. And I know there's, several quotes out there about compounding interest, about how it's like the eighth wonder of the world. And,
that's right.
It truly is like the way to the sustainable way to get really wealthy over time.
That's right.
And
getting rich slow, not getting rich quick.
Right. Where like a lot of people that come into the markets, they're like, okay, how can I just make one trade and get rich really quickly? Where what you're saying is like the goal is to get the highest over time compounded rate, because the higher that is, the more exponentially your wealth is going to grow.
Yep. You want that smooth exponential growth curve of your wealth.
And that's what took you guys from 100 million to like $1 billion, right?
Yep. That's correct.
Cool.
Yep. So, and obviously an extreme example of this is one of the world's most famous investors, Warren Buffett. I like to show this graph. It's actually a log scale graph, but if you started with $100 in 1965 and invested with Warren Buffett, you would actually have over $1 million by 2015. Now, the S&P 500, again, like I said, 8% average annual return, one of the best asset classes. But if you started with $100 and put it in the S&P 500 in 1965, by 2015, you had about $10,000. So, that's a good 10x return over that period. But, if you're able to compound returns like Buffett did at over 20% a year for 50 years, the difference in wealth creation is so massive, right? The difference between $10,000 and $1 million.
And what was the difference in average rate over this time, you think?
Yeah, Buffett's returns were just over 20% average annually.
So this is like 8 versus 20, 10K versus over $1 million.
Exactly.
Yeah,
exactly. So now another way to think about the opportunity in stocks is not just, the compounding returns, but how many stocks a year actually deliver really great returns. So I created this chart, I think late last year. It goes through 1998 to 2017. I looked at the number of stocks that went up more than 100% within a year. And these are listed stocks, not including, penny stocks or OTC stocks or anything like that. These are large listed companies in the US alone. How many companies each year doubled or more in value? And so you can see that in most years, you've got, north of 100 companies that are doubling in value. So there's a lot of stocks out there that are delivering way more than that 8% average annual return of the index. You've got lots of stocks that are doubling in value. So that's one of the ways to look at the opportunity. In the past year, the S&P 500 has delivered relatively in line with its historical average. I think it's up about 7% over the last 12 months. It's had a rocky road, but when we look at, actually, I ran the screener the other day looking at the number of stocks that actually are up in the last year over 50% or more. Well, it's actually 145 companies. Now, these are US listed only, market cap more than 300 million. So I'm excluding a lot of potential stocks that would actually drive that number higher. But we're talking about large listed companies in the US alone. There were 145 that went up more than 50% in the last year. So these are the types of stocks we're looking for. Obviously, this is the amount of opportunity that's out there in the stock market. And that pretty much is consistent across most years, this kind of opportunity. And if you're looking globally, that number grows a lot more, obviously, than 145. You've got hundreds of companies out there whose stocks have significant returns.
So before we move on,
Yeah.
I think we've got a little bit of a delay in the screen sharing.
Okay.
So just to kind of recap, so what you're showing here is just the potential of stocks that, we talk about like what, compounding at 8%, 20%, whatever, but the opportunity is in these stocks that over time, or I guess year by year, have massive growth within 1 year, right? And the goal there is to find stocks that aren't, just going to go up 2 or 3%, but these kind of outlier potentials. This is where you make your alpha.
Yeah, the way to put together a portfolio that compounds above 20% year after year after year is to find great stocks that can go up 50 to 100% or more in value, and put together a portfolio of a number of those. And not all of them are going to be winners, but when you combine those and you have that outperformance, that's what gets you that really high level of portfolio return.
Nice.
Yeah.
Cool.
Let's see what. So let's talk about, how we go about beating the market's return. Unfortunately, most active investors don't beat the market, right? This is a slide showing a report from the S&P Dow Jones, a company that put together a lot of data on active investment managers. They were looking specifically at mutual funds in this example, but over a 15-year period, something like 9 out of 10 mutual fund managers did not beat the index's average annual return of 8%. Which is kind of amazing. So you've got all these highly paid mutual fund managers that are actively picking stocks, and 9 out of 10 of them can't even outperform that market average. And this is why that a lot of investment advisors tell you, well, you should just put your money in a low-cost ETF, just get your average annual return of the market. Don't bother with finding investment managers or people who pick stocks, right?
So just be passive about it.
Right. And for a lot of people, that might make sense. And honestly, individual investors who don't have training, who don't have the right resources, probably do even worse than a lot of these active mutual fund managers. I just pulled a couple screenshots here from Reddit's Wall Street Bets subreddit, which is an interesting place where you can see a lot of people not knowing what they're doing in the stock market, losing a ton of money. Another one is the Bag Holder Quotes on Twitter. That account is constantly every day showing screenshots from people who are just making really dumb mistakes in their stock market investing, losing all their money, just doing the worst possible things. I like to say everyone thinks it can't happen to them. But even when you look at, former blue chip stocks like GE, right? GE's down over 80% over the last 2 or 3 years. And this was a stock that most considered to be like a bellwether blue chip, safe in your portfolio, put it away in your retirement portfolio for 20, 30 years. Well, a lot of people have lost a lot of money, even on stocks that were formerly considered safe stocks like GE, right? Individual investors have a problem even achieving the average 8% annual return a lot of times too, because one thing that we've seen over and over is that individual investors try to time the market with their allocations to the stock market. So they'll have their 401ks or their retirement portfolios invested in some amount of stocks, Then all of a sudden they'll start to see headlines in the news about the stock market being down, and they get worried and they pull out all their money right after the stock market has already taken a big correction. Well, they do it at the exact wrong time. So this is actually from a study that a company called Dalbar puts together every year called the Quantitative Analysis of Investor Behavior. And what it found was even passive market investors that are just putting their money into passive ETFs and things like that are actually not even achieving that 8% annual return, because they're pulling all their money after the market's down and then putting it in after the market seems safe, after it's run up a lot. So you can think about this like, in the financial crisis, after the market was down 40%, a lot of investors pulled their money out when they should have been putting more money in and buying stocks at the lows. Then the market rallied a couple 100%. Then they decide to get back in. So they're getting in at the top when everything's rosy, and they're getting out after the market is corrected at the bottom.
And it's like everybody knows inherently buy low, sell high, but 90-something% of people do the exact opposite.
Exactly.
And it's even people that know better. It's funny how like human emotion drives those things.
Yep. And this is the fear and greed that we talk about. And this is what offers us the opportunity.
Yeah. So I think we're going to try to just share, like, I know you guys probably can't see this as well, but I think we're having some delays on the screen sharing. So let's just keep kind of going like this, and hopefully this will work.
So, when we talk about active investing too, people will say, okay, so what about hedge funds? A lot of institutional investors have been looking to hedge funds to try to beat the market and get those market beating returns. And the truth of the matter is, yes, early on when hedge funds first emerged in the 90s, you have a lot of these famous faces of hedge fund managers like Carl Icahn and Stevie Cohen and John Paulson. They have generated billions of dollars of value for their investors. They were giving 20, 30% types of annual returns year after year in the 90s and early 2000s in the golden age of hedge funds. But part of the problem is the hedge fund industry became really crowded. So now there's all these Me Too pretenders raising hedge funds, and returns as an industry have compressed. And hedge funds is a very broad term now, covering a very broad industry. So it's hard to make really good generalizations about the performance of hedge funds these days. Some of them are not very good, and there are still some that are very elite that outperform the market, make great investments, make lots of money for their investors.
Would you say there's like a common thread between like Teton, I know they're still ranked as one of the top Barron's funds. Like, what is the biggest differentiating factor? Or I guess that's kind of the core of what you're going to talk about with the 3 keys.
Yeah, exactly. Yeah, we're going to get into that. A lot of the problems with some of these larger hedge funds today is that they just are managing so much money now, and they're in so many different strategies, and they have so many sub funds that, there's not that many people that can truly deliver alpha, especially with large amounts of assets, because you can't go everywhere. You can't invest in all the interesting things when you're running $100 billion fund. And so that makes it more difficult just mathematically to achieve market beating returns. So I'm going to talk about this a little bit, but one of the great things about a smaller fund or about an individual investor who knows what they're doing is the smaller capital base that allows them to go out and invest in lots of interesting things and really outperform everyone else. So,
right. Makes sense.
Yeah, this is just showing some of those hedge funds that I just talked about, some of their long-term track records. It is definitely true that the elite hedge funds out there have produced massive alpha and massive returns for their investors.
So I know you guys probably can't see these numbers. What are we looking at here as a gist of it?
Well, unfortunately, this doesn't show the percentage returns, which is what we'd really be most interested in, but it shows the billions of dollars of gains since inception.
Oh, okay.
So like Bridgewater, which is Ray Dalio's hedge fund, here it shows $58 billion of gains since inception in 1975. Things like Soros, George Soros's hedge fund, has added billions, tens of billions of dollars of value for its investors. So these are some of the names that you'd probably be familiar with. Paulson and Company, right? John Paulson made that famous bet against the CDS housing, and before the housing crisis hit, made billions of dollars on one trade. So these are just some of the famous hedge fund managers that you've probably heard about.
Gotcha. And this is the long tail. So you would say most hedge funds probably just underperform.
That's right.
But these guys, and then guys like Teton, those are the outliers.
That's right. Yeah. And so, the top hedge funds have a number of advantages over your average investor, right? They've got lots of teams of portfolio managers and analysts who are formally trained, in finance, accounting, quantitative fields, mathematics. And, they go through apprenticeships as well. They go, as I did, they go intern and work at Goldman Sachs. They go work for other hedge funds and private equity funds. They get a lot of experience actually making real investments. It's their day job. They get paid to do it. Mm-hmm. They also have access to institutional tools like Bloomberg terminals, which people, we paid $25,000 or $30,000 a year for each one of us to have a Bloomberg terminal, for instance, which offers you lots of different data sources, data feeds, information that the individual investor typically can't get access to, at least somewhat. Mm-hmm. These larger elite hedge funds also get access to management teams. They get to sit down with the CEOs and CFOs of a lot of these companies. In some cases, they get appointed to the boards. And so they get to help these companies actually make decisions. And, they have access to brokers, Wall Street banks who do a lot of the IPOs and make deals with companies. And so they get information flow from them. So there's just lots of advantages that the truly elite hedge funds have over the average investor. Now, the question is, I talked a little bit about this, but, these are some of the techniques that some of the elite hedge funds have used in the past, right? The ability to go long and short. So the ability to bet on things going down, like John Paulson that I just mentioned. He was able to short CDS against the housing market, very asymmetric trade. Not a lot of individuals could probably do that. There's a lot of things like activism. Hedge funds can get involved and actually create change at companies by getting involved on the board and pushing for changes in the management team. Obviously, quantitative strategies, a lot of quant funds like James Simons at Renaissance, they're running teams of PhDs creating mathematical models and, doing high frequency trading and things like that your average investor at home can't really do.
Yeah, that's kind of what pushed out a lot of the old school futures traders is, after the financial crisis in '08, before that, it was like mostly humans trading futures. And then it was like every year after that, it was just more and more quants. And they just kind of like made things more efficient on those smaller time frames. So it became harder and harder to day trade, where like you could still make money like longer term, swing trading and riding trends, right? Like momentum has real alpha behind it. But quants, I mean, that's a huge advantage.
Yep. Yeah. So there's a lot of unusual techniques that hedge funds employ to try to, beat the market, and gives them certain advantages over, an average investor. So the question is like, can an individual investor compete? Like, should we be trying to beat the market? Should we be making investments in the stock market actively? And I think the answer is yes, absolutely yes. Individual investors have some key advantages over a lot of the elite hedge funds and over a lot of the investment managers out there. And one of the major advantages I just talked about earlier is the small capital base. As an individual investor, you can invest in pretty much anything. Your asset base is not going to be tens of billions of dollars. Mm-hmm. Your asset base is probably not even tens of millions of dollars, which opens up the entire world of investment possibilities. Yeah. Whether that's small cap stocks, international stocks, it can be, pretty much anything. You could also invest in large stocks too, in large cap stocks. So your range of investment potential is so wide.
So like say you're at a $50 billion hedge fund.
Yep.
It wouldn't really make sense to get into a $1 billion position maybe. Right. Because it's such a small percentage of that capital that it's not going to really move the needle. So you really only need to be in the most liquid stuff, which maybe isn't going to have the most range or the most growth potential.
Yep, it's exactly right. I think I have an example on one of these next slides. Like, this is a perfect example of a stock where, in 2011, 2012, this is Patrick Industries. It's a company that makes components for RVs and boats and manufactured housing. And so, this is a company that over the last decade has done incredibly well, but it was a less than $100 million market cap company in like 2011. And so really only smaller individual investors could have invested in this back then. The stock has gone on to now be over $1 billion market cap. But hedge funds, most large hedge funds could not have gotten involved in this stock until it was over $1 billion of market cap. So that was 2017. So they couldn't really get involved until after the stock had gone up 10x or 1,000%. So they missed a lot of those big gains from the stock going from 100 million market cap to $1 billion market cap.
I think we saw that. That's kind of similar to Bitcoin in the early days. Is like, from 2013 to 15, hedge funds and bigger investors weren't interested for obvious, it's just early to the game reasons, but also just the size, like if you're going to try to invest $1 billion in Bitcoin back in the day, you're going to move the market so much, get so much slippage. It's not really worth it. Is that kind of the same thing here?
Yep. Same idea. Yeah. At our hedge fund at Teton, even when we had a couple $100 million under management, to get a meaningful position, we need to be able to put to work at least $10 or $20 million into a stock. Well, on a $100 million stock, that's 10% of the company. And there's actually filing requirements that the SEC requires you to file once you get to a 5% or 10% ownership of a company. So now everyone starts to be able to track your trades. You get more restricted on how you can trade the stock once you get to that type of ownership level of a company. So dealing in small cap stocks, even for a smaller hedge fund, is very difficult. So your investment universe is smaller and smaller as your assets grow larger and larger. Let's see. Down. Yep. Nope.
Oh, there we go.
Oh, yep. So yeah, there's actually studies that show that the larger your asset base is, the worse your performance typically becomes. And so the correlation is, larger asset base, lower performance. And that makes sense. But it's cool to see that in the academic research. And that's true both in private equity as well as, public market investing and hedge funds. There's lots of different studies. Even in venture capital, I've started to see some studies that show this. And, Warren Buffett has even talked about this issue. He says, size is always a problem. And with tiny sums of money, it's extraordinary what you can do as an investor. I think he even at one point said that he believed that he could do over 50% annual returns if he, was an individual investor with a small capital base. So, that goes to show you that as these investment managers start to accumulate all these assets, it gets harder and harder for them to deliver high returns.
Makes sense.
Yeah. So the other thing that really gives the individual investor, lots of opportunity in stocks is this timeless fear and greed that's always present in the market. On this slide, I show Charlie Bolello is a guy on Twitter who posts a lot of great charts. And this one shows a lot of the stock market corrections that we've seen in the last decade and all of the reasons behind them. And the reasons are so numerous, right? Whether it's trade war worries or earthquakes or Brexit or, worries about economic recovery and, falling oil prices in North Korea and all these different geopolitical concerns, right? There's always something creating worry in the market. There's always something creating little corrections in the market. On the opposite side, you have the greed factor, right? In 1999, 2000, this is probably the most extreme example of this. The market was going parabolic. It was at all-time highs, crazy valuation levels. Someone wrote a book called Dow 36,000, claiming that the Dow was going to go up 3 or 4x in a couple years and be at 36,000 by like 2002, 2003. Well, we're 20 years later after the dot-com bubble, and the Dow still has not hit 36,000. So this is the kind of greed that people get into once markets start hitting the highs. And people just do silly things when stocks and markets get to really silly levels. So yeah, this book was published in 1999, and here in 2019, the Dow is still below 30,000. So
yep.
These are the kind of silly things that people will say and do in the market. Let's see if we. All right. Another way to see the opportunity is, there's persistent volatility in single stocks. This is some data I put together showing the low to high change. And these are very large cap, very stable companies like Home Depot, Walmart, Microsoft, Google, Amazon, all the household names you've heard of that are large companies with large revenue bases. And even in a given year, like 2017 was a very stable year for the stock market historically. Very good, strong year for the stock market. Even in a year like that, we saw a lot of these stocks from their low to their high moved about 40 to 50%, a lot of these. So I think the average change for a lot of these stocks from their annual low to the annual high was 40% among this group of stocks. You can imagine the number would be even higher when you start to look at smaller, more underfollowed companies.
Yep.
So there's just a lot of intra-year volatility, even in very stable companies in the market.
Even like talking about this year, Apple recently, it was down, what, 35 or 40%. And I know Nikki bought a ton of Apple, and that turned out to be a great bounce play. So
Absolutely.
even like the stuff that, like the big names, I think the point here is like intra year, if you're waiting for those big dips and those big moves, that's where you can also get a lot of alpha.
Yep. So that offers individual investors lots of opportunity if they're doing the right things, making the right psychological moves, and really understanding market psychology, understanding risk and return. We're going to talk about that here in a minute. We're going to talk about how we put that into practice.
Cool.
So yeah, the 3 keys to making a great stock investment. And we're going to go through each one of these in depth. So the first key is avoiding common mistakes. And this is really the first and probably one of the more important things that an individual investor really has to learn to do. So the first common mistake is overtrading and trying to be real cute about timing entry and exit, either into the market or even into a specific stock. I talked a little bit about this already, but there's lots of reasons to worry in the stock market, right? Every couple months, there's something the market is worrying about, something that traders are worrying about, whether that's, Fukushima or, government shutdowns or trade wars or, what the Fed is doing or what commodity prices are doing or weird things like Ebola, right? So you can see here all the different things over the last decade or so. And this is actually just a truncated list of things that made the market freak out. And, you could have sold all your stocks at any point here. And a lot of people do. They worry about these things and they sell their entire portfolios. But if you had just bought in March of 2009 and held through, I guess this chart just goes through March of 2017, but you would have had a 250% gain if you had just held through all that kind of stuff. And so the mistake here is just focusing too much on fear and news headlines and getting shaken out of your positions and getting shaken out of your convictions. We know that the stock market produces good, solid, long-term returns. We know that. We see it in the data over a long period of time. And yet people will still make the mistake of getting out of the market and thinking, I'm going to get back in when everything looks good and when it's safer. And it just turns out that it's really never truly safe. There's always uncertainty and always fear happening in the market. And so you want to use that to your advantage and not, be subject to that and selling your positions at the wrong time.
Yeah. I mean, fear sells.
Yeah.
Fear is sexy for a lot of people. It's one of those things that, there's a lot of newsletters I see with the perma bears, the guys that have been, ever since 2009, every year calling for a market top. And those are the guys that have probably performed the worst or missed out on the biggest gains.
That's right. That's right. So a prime example of this is a very recent example. I don't know if any of you are familiar with Roku. They're a company that makes, they do software and boxes that help people cut the cord and subscribe to streaming services. And so they provide an interface, hooks into your TV, allows you to have all the apps like Netflix, Hulu, Amazon Prime, those kind of things on your TV, and allows you to watch through those apps. And they have their own channels now on their streaming box. The company has been growing very, very rapidly, growing revenue in excess of 50% a year. And, this was actually a pretty high-flying stock in early 2018. But then we got this market correction in the fall of 2018. The market corrected about 20%, the overall market. And, of course, Roku was down even more than that. It went from, I think, about a $70 stock down, dipped even below $30. So this is a company I had been following. This is a company I really admired, really liked their growth trajectory, really thought the market opportunity for them is still huge. And so I was able to pick up shares. My average cost base was about $27 on Roku in late December. I think I was even tweeting about, making buys on December 24th, which was actually ended up being the bottom of the market, at least in the near term. And so I was adding to my Roku position as it had sold off so dramatically. And I was adding under $30 when everybody else was freaking out about the market, maybe even getting out of the market. And, what has happened over just a 6-month time frame, Roku has gone up about 3 to 4x. So it's gone up. We've had about 300% gains on our cost basis in just 6 months on Roku. It's now like a very widely loved stock, and, it's over $100 a share now. So
you were getting in when the fear was at kind of its peak level.
Yep.
And now it's getting closer to euphoria. Are you still holding this one?
I've now sold, but it's still a company I very much admire. But the risk reward changed a lot, and and obviously I wanted to take some gains. But yeah, so a prime example of using a market correction and not freaking out and selling all your stock, but actually buying the ones that are doing very well.
Yeah.
So the second mistake that I see a lot of, especially newer investors make, is focusing on, you don't want to buy junk stocks and penny stocks. This is an area of the market. I made this mistake when I first started getting into stock investing when I was in college, because everyone wants to be able to turn $5,000 into $1 million in a year, right? This is like what a lot of those shyster newsletter guys are trying to sell, right? Get rich quick schemes. You know, you've got to hone your bullshit meter. If it sounds too good to be true, it probably is.
Yep.
Very few investors ever turn $5,000 into $1 million in a very short period of time. That's just not the way to invest. And that's not how elite investors invest. We never touched penny stocks at the hedge fund. We were able to put up great returns, and we're just in, listed real companies, not dealing with OTC and penny stocks. There's a lot of problems with penny stocks. The SEC, actually, this graphic shows, they've done some studies of investors in penny stocks, and the majority of them, over 2/3 of investors that invest actively in penny stocks, lose money. If you've ever seen the movie Wolf of Wall Street, these are the types of shady guys, and this is based on a true story, right? These guys still exist. These boiler room brokers exist to steal money from mom and pop investors.
Yep.
And they do that by dealing in really shady penny stock companies.
Reminds me a lot of kind of the scammy ICOs that we saw in the crypto space the past couple of years.
Yeah.
And I know, just anecdotally, like from some of the OTC stocks that I've tried to trade over the years, it's amazing how you can get stuck in those positions. Even if you're not trading big size, nobody likes to talk about their losses in that space, but like the risk of getting stuck in a long when it's crashing against you, or if you can find shares to short and you get a short and then it squeezes, and like getting out is also like virtually impossible. It's like the risk to reward there is just so much more stressful, it feels like.
It is. And there's just scammers hiding in the shadows, and pump and dumps, are all over the place. And, the spreads are wide. So you can buy a penny stock at, a cent, but then you've got to sell it at a half a cent. The spreads are so wide that it's a 50% spread on your cost. So, it's just a bad place to be. And there are plenty of opportunities outside of penny stocks to make a lot of money.
Right.
So the third common mistake is obsessing with the news. This sort of goes with the first point a little bit. Financial news is entertainment. It is not a place to find real information about investing. Typically, occasionally they'll have on like a Fed governor to do an interview or something like that might be important. But really, for the most part, CNBC, Fox Business, it's just junk food for the mind. And so,
I like how you said that.
Yeah. And I love this picture. This is actually an example of what happened in crypto, but CNBC, famously was talking about buying Ripple near the top at $250, a coin. And then they were talking about how to sell it at 71 cents. So they're doing the exact opposite of what they should have been doing, right? You want to sell greed and you want to buy fear, and they're doing the opposite. And the other problem with financial news is that they focus too much on whatever stocks are in the news that day, that week, so they're constantly covering the same 5 or 10 companies. Right now, that would probably be Facebook, Apple, and Tesla, right? So you just hear the same things about the same 5 stocks over and over. You don't want to be focusing on 5 or 10 stocks solely that are in the news, especially. You want to be focused on things that not a lot of people are focused on. And you want to be looking in places where not everyone is looking, and you want to be taking your own data and opinions and not listening to some journalist on the news, because they're not trained in finance. They're not trained as investors.
Yeah. And if you think about what their goal is, it's to get more views or it's to get more clicks. It's not to help you make money.
That's exactly right. So the fourth common mistake is ignoring fundamentals. I see this a lot with new investors as well. There's really no excuse not to learn and understand what things like market cap and enterprise value are, what a PE ratio means and how to calculate it, what revenues are and cash flows. These are the things that longer term drive stock prices. And a lot of people just get caught up with hot stock tips from their neighbor, or, this is a great example. This is Tilray. The marijuana space is definitely interesting, right? We know that marijuana is being legalized in more and more places, more countries, more states here in the US. And it's a big market. We know that it's a big growing market. But that doesn't mean that every stock in that market is going to perform super, super well. You have to focus on fundamentals. Tilray IPO'd and went from, I think a $30, $40 IPO price within a couple weeks was up to over $200 a share. And even there, people were buying in like, oh, this hot stock, it's going to the moon, right? And your neighbor's, you're looking over at your neighbor and he's talking about how he's getting rich on marijuana stocks. Well, if you bought at the peak, if you bought at $100 or $200 a share, you're now down a ton. The stock is down 80% from when it went parabolic up there. Yeah. And that's because, this thing had a $20 billion market cap near the peak, despite having very minimal revenue at the time. And, despite having a lot of unclear competitive advantages, there's lots of competitors entering this market. There's lots of still regulatory uncertainty. This company may go on to be a big company, but you can't give it a $20 billion market cap before it's proven the ability to produce real revenue and cash flow.
Yeah.
And so
that's exactly what happened with Ripple, right? Talking about how CNBC was basically pumping it at $3. Your average mom and pop investor was thinking, oh, well, if it's anything like Bitcoin, it's going to go to 10,000. But they didn't realize that the supply was so much higher that the market cap was already super high. So even a move to $5 would put it, like close to Ethereum's value. So like, I think that's where like the stock price can just be deceiving, right? Like you can have a $1 stock that's way too expensive or $1,000 stock that's actually at a deal, depending on the value of the actual company and the total market cap.
That's right. Yeah. In my stock course that we've given away free to our community members, I go through a lot of these fundamentals. I talk about share price versus market cap, which is a critical thing to understand. Because the value of a company is not based on its share price. You can have a company with a very low share price that has a high market cap, which means the equity of that company is being valued very high, but its price per share is low. So, market cap depends on share price and shares outstanding. So there's a lot of confusion about share price versus market cap, things like that. Fundamentals like revenue and earnings, enterprise value, debt, those things are very learnable things. I have a great course that covers a lot of that for newer investors who are new to it. So there's really just no excuse not to educate yourself. And buying stocks and ignoring the fundamentals is a good way to lose money.
Absolutely.
So the second key to making a great stock investment is to be a contrarian. And this one is very, very important. And the word contrarian basically means to go against the herd, to be someone who forms their own opinions, to be someone who doesn't just listen to what the herd or everyone else is saying or focusing on.
Is that keyboard not working?
Let's see. Sometimes the down works and sometimes the right switch works.
Like I said, guys, we're still figuring all this stuff out. So thanks for being patient with us. I know we've got some of these slides that are like delayed, but we're going to try to keep up with it.
Yeah, so part of being a contrarian is looking for new stock investments in places where very few other people are looking. It's not looking for the hot stock of the moment that CNBC is talking about. It's looking at things like busted IPOs, stocks that instead of buying stocks when they're IPOing and super hot, you're actually looking for the ones that maybe just went public 6 or 12 months ago that are now like no one's talking about. The stock price is down 50%, but maybe
like Facebook was a good example of that. I think
Facebook
right?
is a great example. Yeah, the company went public at I think a $40 or $50 billion market cap, and then over the next like few months sold off 50%. And, there were all these people that's, it's dead. They can't figure out mobile, whatever. Well, if you were an investor who has the right radar, you start to say, well, at what price does this get interesting? Should I start taking a look now that everyone else hates it?
Yep.
Maybe they are doing some right things under the hood. The market still is huge here, obviously, globally. So, yeah, Facebook is a good example there. Etsy is another one, actually. Etsy was an IPO that sold off for about a year, went down to $8 or $10 a share, was worth, I think, a couple $100 million. And, they had sort of left it for dead. They thought Amazon was going to crush the company, but there were some smart investors that got involved and saw that actually Amazon's product wasn't that competitive. Etsy had a new turnaround planned in place, and that stock has gone up like 8x from that post IPO low.
Nice.
Another place to look is sectors that are out of favor. So this happens a lot where, right now tech is in favor, but there are a lot of sectors that are out of favor. After
retail or
retail's out of favor, auto, anything that, has any exposure to a weakening economy at all, has just been decimated. So housing, auto, retail, anything, everyone hates it. Everyone loves tech and hates all that other stuff. Well, I'm actually looking at all this other stuff because there's hundreds of companies that are in those sectors and they're all just being sold like baby thrown out with the bathwater kind of thing. So those are great places to look. And, I have some great examples of that, which I'll talk about in a minute. But another place to look is smaller companies. Like I mentioned, as an individual investor, you have access to a wide range of opportunities. So like that Patrick Industries example I showed earlier, but there's thousands of small companies where you can find some interesting plays. Turnaround stories is another one. An example would be like banks after the financial crisis. Of course, everyone hated banks, even 2-3 years after the financial crisis. But that was actually a place where you could have made multiples of your money over the next couple of years in bank stocks. So a lot of these bank stocks were left for dead, but they had raised capital. They started to actually repay back the money that, they had taken in the bailouts. And it's funny because even still today, I see people talking about the bank bailouts, and most people are just thinking about headlines, and they didn't actually look at the companies and see that a lot of these companies actually took that bailout money and then paid it back with interest to the U.S. government.
Yeah, nobody likes to talk about that.
Right?
It's not sexy.
Yeah, but they recapitalized, they reorganized their businesses, they sold off a lot of the bad assets. Bank of America at one point was a $4 stock. I bought it, I think, near the lows, near $4 or $5 in 2012, and it became a $30 stock a few years later. So these turnaround stories can be very powerful. And then companies dealing with controversies. So Facebook is actually a good example. A couple months ago, stock sold off 30-40% because of controversy over their privacy issues and data issues. And, maybe those issues aren't over. I think we're still working through a lot of that. But if the company gets punished to such a degree that the risk reward becomes in your favor, becomes interesting. So sometimes companies dealing with controversy, those stocks will be sold off as if those companies are going to zero, when in fact, they may need to work through some issues, pay some fines, but then once they get over that hurdle, they...
So that's really interesting, right? It's like you take a company like Facebook it's easy to hate on it. It's easy to want to hate on it. And as a crypto guy who is also like libertarian minded and, privacy focused, like I agree, like Facebook has fucked up pretty majorly over the past couple of years. And it's easy to just hate on that and to push it to the side and say like, no, of course I'm never going to buy that stock. I hate that company, right? But as an investor, if you're wise, you're not going to inject your own opinion about the company. You're just going to look at their current situation and then the valuation with all the hate, right? Because the hate drives the price down. And a lot of times, like you're saying, like look where no one else is looking, or look where people don't want to look because their own personal biases won't let them go there.
That's right. Yep. Warren Buffett actually made one of his most famous investments in a company dealing with controversy. Back in the early 1960s, American Express was a company that he bought during the middle of a big controversy. It's called the salad oil scandal. So American Express had basically lent a bunch of money to this shady fraudster who was running a company. He was claiming to have all this salad oil in all these tankers, and he was using those tankers as collateral to get a bunch of loans from American Express. And it turned out that he just had a little bit of salad oil sitting on top of like mostly water in these tankers. Oh, it's a really funny story.
It's like seeding a gold mine where they go in and like put little pieces of gold to make it seem like they hit the pay dirt.
Yeah. So anyway, it turns out this fraudster obviously got caught. American Express had some losses related to this, to the loans that they had lent out to this fraudster, but it wasn't enough to kill the company. And the stock had been so decimated that everyone else had left it for dead. Buffett bought a big stake, I think a 5 or 10% stake in American Express for like super, super cheap prices. And American Express obviously had another 30, 40 years of long growth runway. And so he got it for just an insanely cheap price and has pretty much held it for like 3 or 4 decades and done very, very well. It's been one of his longest, best performing investments. And so that was one that he bought during a controversy when everyone else hated it.
Nice.
Spinoffs are another place to look. Sometimes big companies will spin off a division. That division will be very small, and so that stock will be small. So a lot of the big investors that were invested in the big company have to sell that smaller spinoff stock because it's too small for their portfolio. And so these spinoffs sometimes have a lot of technical selling pressure on them. They get sold off to really silly levels, and sometimes they're actually even really interesting, good businesses that have a long growth runway, and you can buy it at a great price because all these other institutional investors have ignored it. And there are some other places too, but let's talk about some examples in this category of looking at places that are out of favor. The airline industry, classic example. In the first decade of the 2000s, airline stocks as a sector, not just one airline stock, but the entire sector, shown by this ETF here, lost about 80% of its value. And there's a number of reasons for that. And a lot of those were fundamental driven reasons. It was a very competitive industry. Oil prices had gone up a lot, so fuel costs were becoming a problem. Airline margins had just gotten destroyed.
You can see 9/11 on the chart, actually.
9/11, yeah. So fears over flying definitely hurt demand for a while. So the sector lost 80%. And there used to be all these quotes from Warren Buffett, too, about how, the airline sector just, never really made money over a long period of time and just was a place to avoid looking at companies. And, that was probably the right way to look at it in the early 80s, 90s, and early 2000s, because it was such a competitive industry and they weren't charging enough for fares and things like that. Well, it turns out airline stocks after 2010 have become an absolutely great place to invest. And in fact, Warren Buffett has now invested in airlines. So the airline industry from 2010 to 2019 was up over 200%. So you can imagine even some single stocks within that industry are up even more. And the reason that is obviously, a lot of you probably know, the airlines started consolidating. So they started to become a lot more disciplined on capacity, pricing. They started unbundling their fares and charging for things like baggage and, economy versus basic economy versus, space, seats with more space and first class, right? They started figuring out all these ways to increase revenue. And so that has made airlines as a whole just a better business. And like I said, even Warren Buffett has now started investing in airlines, which is kind of wild. But if you had just listened to the conventional wisdom in the mid and early 2000s, you would have missed this opportunity to buy airline stocks. So sometimes it does make sense to go look at what everyone else hates. An example of an investment specifically recently that I made was in a company called Fiat Chrysler, which spun off Ferrari, which trades ticker symbol RACE or race. So Fiat Chrysler has the Ferrari actually is kind of the product of two of those things on my list. Not only an out of favor sector, which is the auto sector, but also a spinoff here of Ferrari. So Fiat Chrysler owned Ferrari as well as a number of other brands, and they spun out Ferrari into its own company. It went public. That spinoff went public at about $50 a share in early 2016. And, a lot of investors probably weren't paying attention to it, probably just saw it as like a little niche brand. But it turns out that there were a lot of really positive fundamental things happening at Ferrari. And so Ferrari has gone up about 3x since that spinoff. And so that was an opportunity. I was actually involved in Fiat Chrysler even before Ferrari spun off because it was an interesting company with a lot of interesting developments. But we were able to make about 200% gains in about a 3.5 year time period.
Nice.
So very, very interesting one. The next part of being a contrarian is to do your own work. And I've talked a little bit about this already, but you don't want to be relying on the consensus. You don't want to be relying on comments on CNBC or what your neighbor says. Do your own work. And that means, reading through the conference calls that these public companies have, reading their financial reports, looking at their investor presentations, forming your own opinions. Sometimes it's even just testing out the products. Some of these companies have products you can actually go use and test, talking to some of their customers or other people that use the products, running your own numbers and calculations and forming your own opinions is all a very important part of doing your own due diligence, doing your own DD, as they say.
So with that, like, I can see how the average person's like, look, dude, I have a job, or, I'm not a full-time investor.
Yeah.
What's the 80-20 there? Like, where can I leverage my time? Or like, where are the most important places to place your focus?
Yeah. Well, I mean, we actually do a lot of that in the community itself. Like, and you're able to have a resource like me who does spend their full, waking hours looking at stocks and companies. But, there are tools for individual investors where you can go get, quick, bites of information like Seeking Alpha or Koyfin or places like that kind of assemble a lot of the financial information and not as much the qualitative side, but definitely a lot of the financial and kind of news related information into one place where you can go kind of, see a lot of that as an investor. But you do kind of have to train yourself to figure out where to look and what matters, and also what makes an idea not a good idea. So being able to kill the idea really quickly. So like, for instance, if I'm looking at a company, one of the first things I look at is its balance sheet. What does the debt versus cash profile and cash flow profile look like? If they have levered the company up too much, and the debt is just an excessive problem, I'll stop, after 5 minutes of looking at the company. And so you got to know some of those factors, like net debt being one of them, that helps you kill a company right off the bat, so you don't waste time on it.
Yeah, I bet that's really helpful, right? Like, having those key things that you can look at that go, man, this is going to save me days or weeks of work.
Absolutely.
And then with that, just kind of a random question, like, whenever you're looking at companies and you're doing this research, what percentage of them would you say get past that like initial kill filter?
I would say probably 3 out of 10. So if I start with 10, if I had 10 companies to look at in a given week, it's more than that for me usually, but let's say I had 10.
Yeah.
3 of them would pass the kill filter. And then I would probably go on to make only one of those become an investment, an actual, investment that I put capital into.
So probably less than 10% of the companies you're actually interested in.
You want to be very selective about making your investments. And that's because you don't actually need that many great investments to be a great investor. You're looking for that needle in the haystack. You're looking for the ones that have asymmetric risk reward.
Yeah.
I'll talk a little bit more about that here in a minute.
Cool. Let's keep going.
Yeah. So the other part about being a contrarian is not to rely on Wall Street analyst estimates. So if you're familiar with Wall Street analysts, these are the sell-side analysts that work for large Wall Street banks like Goldman Sachs, Morgan Stanley, Citigroup, Bank of America, Wells Fargo, etc. And they put out these research reports on public companies. But if you understand their incentives, it's not to actually make good investment recommendations. Those Wall Street analysts exist to actually get business from the companies that they cover. So they want to be able to do the debt deals and the IPOs and raise equity capital with these companies. Their recommendations are not to make money as an investor. So elite hedge fund investors, buy-side investors, barely pay attention at all to sell-side or Wall Street analyst estimates.
You mean there's a conflict of interest? No way.
Yeah.
Get out of here.
Yeah. Wall Street analysts have a massive conflict of interest, and their pay relies very little on the accuracy of their ratings. And actually, this chart shows you that they have an extreme bias towards issuing buy recommendations on companies. They almost never have a sell recommendation on a company, even when that company is total crap or is trading at an insane valuation. They don't issue sell recommendations hardly ever. They almost always have a buy recommendation on a company, no matter what company it is. It just goes to show you that Wall Street analysts' estimates and recommendations just shouldn't hold a lot of value.
Cool.
Yeah. Sorry about this. So an example of something that fits in this category of being a contrarian and doing your own work is Lululemon. This is a stock that has done very, very well over the last couple of years. But this really fits in the category of not focusing on these Wall Street analyst estimates, not playing the quarterly earnings game. You have to think longer term. So with Lululemon, this was like earlier mid 2017. It was a company I had looked at because it had actually been part of a controversy as well. There was something happening with their pants being like they had made a certain amount of their pants that were like too see-through. And so people were returning a lot of them. But the core of the company was still very interesting because they were in a hot category, athleisure, that was growing. You could see it around you. And one of the things that interested me personally was that they had a men's line that they were starting to add products to. So just a few products in the men's line initially, but I could see that there were other people around me starting to wear more of the athleisure products. Men were starting to get into it. And I actually would go to some of the stores and look at the product, look at what they were coming out with, bought a couple pieces, really did that like Peter Lynch style, like do your own work, use the product kind of thing. And I could see that the opportunity was massive. And I could see that the longer term opportunity for the company was huge. And Wall Street analysts were still focused on like short-term issues, next quarter earnings, dealing with the see-through pant issue. They weren't focused on the potential for this company to be huge, to be like the next Nike. And so myself and Nikki identified this opportunity in Lulu stock. We bought the stock, believe average cost around $50 a share or so. You know, the stock trades for like, I think $180 or $190 a share or so today. So, you know, we've had a multi-bagger, almost, 250% gains or so in the stock in about a 2.5 year time frame. And that's all just by really being a consumer of the product and trying to understand what the longer term outlook for that company looked at.
And not being too short-sighted,
Exactly.
not pulling up Kramer on CNBC and hearing him go, sell, 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 freak out, invisible pants, see-through pants.
That's right.
Being able to see the forest through the trees and like the long-term play.
That's right. Exactly right.
Nice.
All right. So, did I skip too many? Or am I in the right place? Yeah. So, another big one as part of being a contrarian is to take advantage of market corrections. You know, I showed that chart before of all the freakouts that the market has all the time about different things, right? And so what you want to do is you want to use those corrections to your advantage. Use the fear to your advantage. Don't be the one who sells the stock at the worst possible time. You want to follow lots of companies, create that big universe of companies that you're interested in and looking at. Soak up as much information as you can, be working on looking at those companies, identifying which companies you think are interesting, and then buying them at those opportune times. Like Roku is a great example of that. You know, I used that market correction to buy the stock of a company that I had originally thought was, too pricey. But once it got down to the levels at which I thought it was a really good risk reward situation, I bought that stock and have profited, pretty handsomely from it since, because I used that broad market correction as my buy trigger.
Nice.
So this actually shows this data here, this little table you can see. This is really interesting data that shows since 1987, the forward returns when the S&P 500 gets to a level of extreme fear. So there's a sentiment gauge that where they basically go out and they interview people and see, who's a bull of the market, who thinks the market's going up, who's a bear, who thinks the market's going down. When it gets to an extreme fear reading, which means most of the people that they're surveying actually are worried, that's when the S&P 500 actually performs the best over the next 3 month, 6 month, 9 month, and 12-month period.
Nice.
The market has the best returns when everybody is bearish. It has the best forward returns when everybody's bearish. When everybody's super bullish on the extreme greed side, the forward returns of the S&P 500 are actually pretty weak. So this, again, just goes to show you that you want to buy low, sell high, but unfortunately, most investors are doing the opposite.
Right.
So
it takes confidence, man.
It does.
It takes guts.
It does. It is difficult to buy a stock whose chart has been going down in the middle of a market correction. But that's why you want to be doing the work and identifying the companies that you think have that great long-term potential, and then being patient and then waiting for them to really just get to obscene levels of valuation.
Nice.
And you want to strike when that risk reward is in your favor. So, and this is just another example, similar to Roku. This was a company that I bought in the last market correction. This was a company I'd followed for a while. It had gotten to near its all-time low or 5-year low in valuation. Celgene, company that owns a lot of really interesting pharmaceutical drugs and has a lot of ones that are in studies that could become blockbuster drugs. Stock sold down to, I think, like 7 times earnings with all these other drugs in its pipelines that could potentially increase earnings over time. So very, very low valuation. bought it during the broad market correction, and it was up 50% in like 6 months because it actually got acquired by Bristol Myers. So this was one that we were able to realize the gains really quickly from where it bottomed out. In fact, I think it was up like 30 or 40% in one day. So again, just using that market correction as a time to buy those stocks when they get to really silly valuation levels. And again, this just goes back to what I was saying before about Lululemon, just thinking longer term. Everyone else is focused on next quarter, short term, market headlines. You want to think, what can these stocks, what can these companies be in 1 year, 3 years, 5 years out from now? Because those are the stocks that end up, being incredible performers. Let's see. Oh, I lost my mouse. Where'd it go? Oh, here we go. Sorry, guys. These slides are not wanting to cooperate. And Square is another example of a recent win that we had where we had to think longer term, where all the other analysts were focused short term. This was actually another one, a busted IPO. This was an IPO that the stock had been down a bit after its IPO. No one was really paying attention to it. Sleepy little tech company, just serving small and medium businesses. And the stock sold off to like 10, 12 bucks a share at one point. I think it went public in the mid-teens and then sold off like 30, 35%. No one was really paying attention to it. This was like mid-2016. Nikki and I, once again, kind of collaborated. She brought it to my attention. I said, oh, this could be interesting. Like, they're growing at about 25% a year. And they've got all these new products that they're talking about actually being able to offer to their small business customers. And they've got this interesting opportunity internationally. They really haven't started selling their product in countries outside the US. So I said, okay, they're growing at 25% today. And the stock's not even super expensive on today's numbers. But if they can accelerate their growth rate or keep that growth rate growing for 5, 10, 15 years with all these new products and new markets, this could be a very, very undervalued stock. So we bought the stock at about $12 a share average cost basis. This became one of the best performing and hottest stocks in the entire market. It went up somewhere between 8 and 10x in the last 2 years. At one point, I think hit almost $100 a share. Has come back a little bit since then, but I think still trades in the low 70s per share today. But it became a darling in the stock market. The revenue growth rates accelerated to 40, 50% a year. And of course, now everyone thinks it's like going to be huge and grow forever and gives it this crazy high valuation. But back in 2016 is when you really should have, as an investor, been thinking about it, paying attention to it, thinking about its longer term growth opportunities. All right, so this brings us to our third key in the keys to making a great stock investments, and that is to manage risk. Risk is a broad term that means a lot of things, but let's unpack that a little bit. Now, the first thing in managing risk is to avoid excessive leverage. This is another mistake that newer, younger investors make, and that's to try to get that turn 5K into $1 million type of return, right? It's using high leverage or using options. I see people on Reddit all the time now bragging about, oh, I'm buying call options on so-and-so's earnings. I'm gonna try to buy a call option and just gamble basically on earnings results from some tech company, right? And this is actually a screenshot from Wall Street Bets showing someone who blew themselves up and got a margin call. The fact is, elite investors, hedge fund investors, don't even use that much leverage.
Yeah.
At our fund, we weren't even fully 100% invested most of the time, much less using any portfolio leverage. I think the elite hedge funds that I know at most have only used like 20% leverage, 25% leverage at most. So they're not levering up 2x, 3x, 5x, 100x. It's a real good way to wipe yourself out immediately. Like options, really, the problem with options, and I've made this mistake a number of times, is the problem with options is you have to not only be right about the stock, but you have to be right about the timing of when that stock price is going to go up or down. So I've had a lot of situations where I was right about a stock, but I was wrong about the timing. And I'm a professionally trained investor, and I'm pretty good at spotting opportunities in stocks, but I'm still not good at figuring out when the market is going to be more rational about that stock price.
When people are going to wake up and realize it.
Yep. So options are a dangerous way to play stocks.
Yeah. So I feel like it's, just like futures or options or any one of these like levered markets, like they're tools that you can use, but I feel like the problem is most people misuse them.
Yep. Yep. Most people are trying to swing for the fences and they wipe themselves out.
So these are just examples of people like posting their blow ups online.
Yeah, these were just screenshots from people's accounts on Reddit where they've blown themselves up and now they're in trouble with their wives. But it's interesting too because I show this book cover here of this book When Genius Failed, because it's not just individual investors that have blown themselves up. This is a famous hedge fund blow up. This was a hedge fund that had a bunch of Nobel Prize winning economists working at it, PhDs, quant fund. And this was the 1998 blow up of Long-Term Capital Management, a hedge fund that had several $1 billion under management. It actually created a bit of a crisis in the financial markets for a few months when they blew up. And they did that because they had over leveraged themselves. They had all these sophisticated models saying, well, it's a 5 standard deviation event for this thing to happen. So it's almost never going to happen. So we can put on this much leverage on this asset. Well, the market doesn't, adhere to nice probability distributions, right? It has fat tails.
Yep.
And Long-Term Capital Management learned that lesson, blew up. And there's other examples. Amaranth Advisors in the mid 2000s blew up in the natural gas when natural gas went wild.
There was a recent one where the guy blew up and lost everybody's money and did that video of him like, sorry guys, lost everybody's money.
Yep.
Just not thinking about the downside, right?
Exactly. Yep. Same thing. He was actually involved in natural gas futures or natural gas options, I think. So
yep.
People just using excessive leverage. You don't need excessive leverage to outperform the market. And this just goes to show the adverse effect of losses. If you lose 50% of your portfolio, you don't have to make 50% to get back to break even. You actually have to go up 100% to get to break even. So it's asymmetric, losses versus gains. If you lose 90% of your portfolio, if you go from $100 to $10,
yeah,
you don't have to go up 90% to get back to break even. You have to go up 900%. You have to take that $10 that you now have and multiply it by 9x to get back to break even. So that's the problem with losses, is they really, really crush you and hurt your portfolio. And if you're losing 50%, now you've got to double your money just to get back to break even. So you're probably taking unnecessary risks and starting to do stupid things.
It's where revenge trading comes in, right? It's like mentally, oh shit, I'm down 20%. Okay, let me be more reckless to try to make that back. And then next thing you know, you're down 80%.
That's right. Avoiding losses is very key. You can see here, I've got a fictional portfolio of 5 investments, each at a 20% position size. And you've got an 80% win rate, which would be a fantastic win rate for an investor, right? It's 4 out of 5 investments succeeding.
Yep.
But your one loss is a total loss. It's a negative 100% or, down, basically wiping your investment out.
So 5 investments, 4 profitable, but 1 you get wiped out on.
That's right. And that one wipeout is enough to turn the return of your portfolio into a negative return.
Mm-hmm.
So you got 4 investments that are doing okay, making 20% each, but that one wipeout takes you down to a negative return for your portfolio.
So avoid big blowups.
That's right. You're trying to avoid the blowups. And to that end, what you want to find is asymmetric reward to risk. Low downside, high upside. And so you can have actually a below average win rate and still produce a nice return on your portfolio with the right characteristics. Here I show an example of a 5 investment portfolio where you actually have 3 losers out of 5 investments, but those losses are relatively contained at only a 20% loss. And then you've got a 35% gain on one investment and a 100% gain, or basically, doubling your investment on that investment number 5. That portfolio has a return of 15%.
Mm-hmm.
So that's a pretty good return for your portfolio with, a less than 50% win rate. But what you've done is you've contained your losses and you've got a nice fat winner there. So that's that asymmetric reward to risk that you want. Contain your losses, low downside, high upside. And I'll show you actually an example. This is, there was recently an interview with one investor I follow. He runs a fund. Chuck Aker runs Aker Investments. He bought this stock, American Tower. And he bought it in, I believe it was early 2002 or mid 2002. it was a stock that had, very, very interesting company. They own cellular towers, so a very stable asset. They had gotten themselves a little bit over levered with too much debt. They had been buying up all these other tower companies. And the stock, and this was also in the middle of a big market drawdown in 2002, was actually that low after the dot-com bubble. But this stock bottomed out below $1 a share and was worth, I think, just $100 million or maybe $200 million market cap. And now today is over $200 a share. I think it's got to be like 10 or $20 billion. No, more than that even. Tens of billions of dollars of market cap, let's say. I forget the exact market cap today. But this has been essentially over a 100x or over a 10,000% gainer over the last, call it 17 years or so. Chuck Aker bought this. He was buying it below $1 a share. Below $1 a share, there was downside, significant downside to the investment, but he knew the upside was probably 10x or better. So you had maybe like 50 to 100% downside, but 1,000% or more upside. And so that's the type of asymmetric reward to risk you'd want to find. And obviously this one turned out very, very well for Chuck. It's one of the better performing stocks of the last decade.
Interesting.
Yeah. And an example that we made recently that fit this criteria of asymmetric reward to risk was Fannie Mae preferred stock. Now, I won't go too much in depth on this story, but it's an interesting one. Fannie Mae was taken over by the U.S. government during the financial crisis and essentially, put into government hands. And the preferred stock, which is a little bit different than common stock, but the preferred stock used to get a dividend, and it is believed that when these entities are recapitalized, which it looks like may happen in the next couple of years, and then they're reprivatized, then these preferred stocks could be worth par value or more. Now, par value on these preferred stocks is about $25 a share. These things had been trading down last fall to about a $5 to $6 per share level. It's one that I've been watching for years. A lot of actually elite hedge fund investors invested in Fannie Mae and Freddie Mac, not only preferred shares, but common shares as well, because the reprivatization could be a catalyst for these things to go up dramatically. Well, they were buying at much higher levels. I watched as these things kind of sold off. People stopped paying attention to them. At $5 or $6 per preferred share, these things have very clear upside of about 5x. And in some cases, there are some scenarios where it may even be more than that. If some court cases go the way of the investors, it could be even higher than that. At the end of the day, what I saw was an opportunity for still probably 50 to 100% downside, but at least 5x upside. So a 5 to 1 or better reward to risk. And no one was really paying attention to them at the time. People had kind of forgotten about it, but there was some movement in the court cases as well as behind the scenes with the government administration that they were ready to start moving forward on privatizing these again. So we were able to buy them $6 a share. They've already doubled over the last 6 to 12 months or so. There's still probably about 100% upside on these.
So you're still waiting for those things to play out?
I have taken some profits, but I still am waiting on some catalysts that could take these even higher.
Nice.
The reward to risk is not as good now. Obviously, it's probably a 2 to 1 or so versus a 4 or 5 to 1. But this was one situation where you had that asymmetric reward to risk that you look for in a great investment.
Nice.
And we alerted our community members, but that was one of the ones that we alerted the community about when we were buying. So, anybody that's part of the community has an opportunity to kind of piggyback on some of these trades.
Nice.
The next part of managing risk is sizing positions. Now, position sizing is one of the most critical things you do as an investor. It's also one of the more complicated topics. We talk a lot about this in the course that I've created and also in our community as well. Can't go into every aspect of position sizing today, but one of the things I want everybody to know and understand is, no investor has a 100% win rate on their investments. And so you can't size your positions too large. I mean, think about that. If you were to put 100% of your portfolio into every position, then you would expect at some point you're going to take a big drawdown because not every position that you get into is going to be a winner. And so, you can't size your positions at 100%. And in fact, at the hedge funds, most hedge funds size their positions a lot lower than, a double-digit position size is actually considered a pretty big position size. So, if you're taking massive positions with your entire portfolio, you are going to eventually take a big drawdown, and that can maybe cripple your portfolio for years.
So just a quick question, like
Yeah.
talking about the hedge fund experience that you've had. So say you have $1 billion assets under management.
Yep.
What would be a typical size for a fund like that? Like a typical position size?
Yeah. So a position size for that fund, some funds won't even take like a double-digit position size. Like let's say a 10% position size on that $1 billion portfolio would be a $100 million position.
Yeah.
Some don't even go that big. At our fund, we were pretty concentrated. So we did take positions of somewhere between, let's say, 5 and probably 15% on the high end.
Yeah.
The other thing you have to understand is as your positions start to make money, they get larger.
Right. As a percentage of the portfolio.
So if you had a 10% position, $100 million position, let's say, that stock doubled. Now it's worth 200 million. So it becomes if the rest of your portfolio was fixed, it's now a 20% position size. So that's something you also have to take into account with your positions is how they grow over time.
Nice. And so moving from, managing other people's money to now trading your own account, would you kind of follow a similar path, or what would you say is different?
The cool thing, about being an individual investor is you can be a little bit more concentrated. And I have been as high as a 20% position size, or maybe even a 25% position size once it's gone up a bit on some of my more compelling investments where it was very low downside, very, very high upside. That's a little bit rare. I would say the average position size for me is probably somewhere between 5 and 10% on average.
Okay. And that's of the portfolio, by the way. So like say you have $1 million, it'd be a 50K or 100K.
That's right.
In something. So
that's right. There's a lot we can say about position sizing. I have some quantitative frameworks for position sizing that I go into, and the theory behind those. It actually takes a lot of concepts from probability, statistics, and gambling. And so we talk about that a lot in the course as well.
Yep.
But and again, we can't know which positions ahead of time are going to be the winners in our portfolio. Obviously, we try to only put positions on that are going to be high reward to risk, that have a high probability of working. But you'd be surprised which ones end up working and which ones don't sometimes. So, and we can't know the ultimate magnitude. We may think a stock has, 200% upside, but it may surprise us. It may go up 400%. Or we may think a stock has, almost no downside, but then it's down 50%, right? So you play in probabilities in investing. It's all about risk, reward, and probabilities. And that's why there's position sizing frameworks, because you can't make every position 100% position size or even a 50% position size. That just doesn't, that math will blow up your portfolio at some point if you're being that aggressive. Typically,
you might get lucky on a few, and then you get cocky.
That's right. And that was actually that chart that I showed earlier was another one from Wall Street Bets, where somebody had a nice portfolio growth curve and then did something stupid, and they were all the way back to the start.
Yeah. I always like to remind myself, I'm like, you're only one trade or one investment away from your biggest loss ever. It could be the biggest win ever, right? And if you're building your size over time, it should be, but don't get cocky.
That's right. And so on the opposite side of the fence, you don't want your positions to be too small. A 1% or 2% position size, if that stock doubles, it adds 2% to your portfolio. That's okay, but that's not going to meaningfully move your net worth in your portfolio over time. So your positions can't be too small, and they can't be too big. And there's a sweet spot. And there's also a lot of discussion about how many positions should be in your portfolio. Anyway, we tackle a lot of these questions in the bootcamp course and in the community because I could go on for 2 hours today about my position sizing framework.
Yep.
But it's kind of beyond the scope of today. But yeah, it's a very important concept, and so there is a sweet spot of position size. And again, like I said, I think that range depends on the fund, your risk tolerance, but generally mine tend to be between 5 and 15% on most of my positions. The other part about managing risk is knowing when to enter and exit a position. So entry and exit timing on your positions. And so this is actually a chart of one of my biggest mistakes ever in investing. This company used to be known as Priceline, now is known as Booking Holdings. Priceline was a company that mostly helped people book airline tickets online in the early 2000s. And bought a company called Booking.com, which became the leading hotel booking site in Europe and in other parts of the globe now. Was a massively value-adding acquisition, transformed the company. A company that I was very, very in tune with and had researched back in 2008, 2009. So I used the market correction of 2008, 2009 to actually accumulate shares of Priceline, which became Booking, at about $50 a share. I actually almost caught the very bottom during the financial crisis of this stock.
Nice.
Bought it for about $50 a share. This stock went on to go up to about $2,000 a share. I think it today trades for about $1,700 per share. I sold it at $150 a share. So I sold this stock for a triple. It was a great investment. I tripled my money within like a year or two. But I missed another 10x.
Well, how come you couldn't tell that was going to happen?
And yeah, there's definitely some lessons here. One of the bigger ones is to not completely sell out of a position that you've done the work on. So there is a trade-off between taking some profits and also leaving some on. And so knowing how to do that is a very important part of investing. So I put these questions here, when should you catch a falling knife? When a chart looks like shit and the stock is going straight down, how do you get the confidence to buy it, and when should you buy it? And then on the opposite end, stock's going up, when do you sell? And those are the questions that you have to really understand. And I have a couple ways of thinking about this now. So scaling in and out. One way to help you manage this process of entry and exit is when you're getting into a position, let's say you're trying to catch a falling knife, you like the company, but the stock is moving down. One way to deal with this problem of uncertainty is to buy a position, a starter position, and then increase it over time. So you don't have to buy the entire position at once. I like to scale my positions in. There's a couple of advantages to that. One, it gives you the ability to make the position bigger if the stock keeps selling off. Two, it gives you time to keep doing more work on the stock and build confidence around your estimates of the company's potential and financials. And it gives you that ability to use drawdowns to your advantage, like I said, to make that position bigger and lower your average cost. So that's scaling in. Doing that is a great way to get into a stock, make it bigger without having to buy it all at once and then watch the stock keep going down and be frustrated, right? Yep. Psychologically, it helps you. And then on the scaling out part of it, I like to take profits when you start to see that greed creep in, right? Like on that example of Square or Roku, for example, those stocks became very loved. The market started taking them to what I thought were kind of crazy valuations relatively quickly. It went from not being very loved to being super loved. And not only that, but I was getting a nice multiple, a nice gain on my stock. And so I wanted to take some profits. And the reason that taking profits helps you is kind of a psychological help as well, because taking some profit on a stock that's up a lot allows you to actually sometimes take your entire cost basis out and you can let the rest of it ride.
It's like free money.
Exactly.
Yeah.
One of the mistakes I made on Booking was, if I had sold some stock after I tripled, if I'd taken my cost basis out when it tripled and let the rest ride, I would have psychologically just been like, yeah, free money. It's in a worst case scenario, I've taken my cost basis out. The position has now basically cost me zero effectively. And I can let the rest ride without having to psychologically think too much about it and worry about it, declining again.
Yep.
So taking some profits, helps you psychologically. It helps you obviously book real cash profit. You do sometimes want to pay attention to the tax implications, right? If you're very close to moving from a short-term capital gain window to a long-term capital gain window, then you might want to wait. You might want to wait a couple weeks or a month if that's what it takes. But again, that's a consideration, tax consideration. It really depends on the position and how long you've held it. But I like to take profits and then keep those runner positions on and allow them to, the market has a way of, hating stocks too much at the bottom and loving them too much at the top. So that it rarely does a stock trade at fair value. And so that's how you should think about, you should always keep that in mind when you're entering and exiting a position.
That's brilliant. And the way I think about it is like scaling out some profit does like three things, right? Like you said, number one, you actually take profit, you pull something off the table. Number two, you can like adjust risk. You can like, adjust stops or mental stops or like reevaluate where things are and hopefully eliminate or even lock in profit to where unless something catastrophic happens, you're not going to actually lose on the remaining piece of that. And then number three, you're open for more profit if it keeps going.
Yep.
So it's like the best of both worlds.
Yep. Yeah. I think as you've said before, the goal should be to catch the meat of the move. You're never going to nail the exact bottom and exact top on a stock. And so you just need to keep that in mind and understand that. And don't let the psychological, oh, what if, or, oh, I should have done this, or I could have done this, affect your investing style. Cool. I think, does that bring us to the end of... Yeah, so knowing when to sell. This is actually similar to, as part of managing risk too. Sometimes it's not a matter of selling because you're taking profits. Sometimes you need to get out of a position when something has changed.
Yeah.
And so that's something that is part of risk management as well, is knowing when to cut your losses. For me, sometimes you want to take advantage of corrections, obviously. But sometimes when the fundamentals of an investment has changed, if the thesis has changed, sometimes you need to get out. This is an example recently, a company called Criteo. They're an advertising technology company that helps companies do retargeting ads. Well, Apple 2 years ago and last year announced some changes to the Safari browser, which makes it more difficult for Criteo to deliver ads for their customers. And Google's Chrome is the browser that still has the most market share, over 50% market share, especially on desktop. Mm-hmm. And so Google had not implemented these types of changes, but obviously it would massively affect Criteo if Google did that. Well, in spring of this year, I had owned Criteo because I thought the stock was very cheap. I thought the probability of Google implementing those types of restrictions that Apple did in Safari, I thought it was a low probability that Google would do that in Chrome because of Google's big ad business. It's sort of like they're shooting themselves in the foot. Well, I was wrong. Adweek came out with an article suggesting that they had talked to some Google insiders in, I think, mid-March or early April, and they said that Google was considering adding some more restrictions that would make it more difficult for companies like Criteo to deliver those retargeting ads for their customers. So that effectively means a massive portion of Criteo's business is at risk. And so I actually had a window of I think a day or two here where the stock was only down about 8 or 10%, but the thesis had completely changed. The growth potential for Criteo was massively now in question if Google starts to implement these new restrictions. So I sold the stock, I sold my position completely and got out. And turned out was actually a fantastic decision because the stock went on to go down, I think, another 20 or 25%. But, the idea here is that like sometimes you just do need to cut loose your position. If something fundamental has really changed, you need to get out. A lot of people, what I see a lot of naive investors doing is they hold on to a position hoping, well, I'll just wait till it gets back to my cost basis and then I'll sell. Then
it'll come back one day.
It'll come back. I'll just sell it at break even. Sometimes you do need to take a small loss and you need to get out and you need to move on to something else that can profit.
And I think that's the importance of knowing both, like at some level, the technicals, right? Like a lot of investors, like I feel like lean too heavy into the chart and they don't think about what the company or whatever the asset is, crypto or whatever, right? Whatever the fundamentals or the story of it is. And then they're late to the game, right? Where if you're paying attention, even if everybody should know that has fundamentally changed, like only a fraction of the people are even going to take action on that right away. So that's your kind of not even really informational edge. It's just you're paying attention. You're disciplined.
I think we're getting close to the end here on the managing risk side.
Sweet.
Yeah, I say don't end up here. Don't end up on the Bag Holder Quotes Twitter account. It's full of people that, thought that they were going to hold on to get back to break even and something fundamental had changed and they end up losing all their investment.
Oh my God.
So I wanted to put together like a case study example of an investment that I made in the past couple of years that kind of puts these concepts all together, those 3 keys to making a great stock investment. So that's what I've got here. This is a company called Crestwood Equity Partners. It's actually an oil and gas MLP. It's a company that owns a bunch of pipelines and assets that help oil and gas companies move their oil and gas from where they extract it to closer to the end user. The ticker symbol on this is CEQP. So let's talk about how this all played out. So in early to mid 2015, oil prices started falling. They fell from over $100 a barrel to actually at one point less than $30 a barrel. There was an oversupply in the market. There were signs that OPEC wasn't going to cut production, and there's all this new shale oil coming online. And so with that decline in oil prices from over $100 a barrel to less than $30 a barrel, almost every oil and gas related stock lost significant value, over 50% of their value. In fact, some of them even more than that. Some lost over 80, 90% of their value in a relatively quick time frame. Now, talking about, a baby thrown out with the bathwater, this included pretty much the entire sector, no matter what the company did, no matter what their asset base was. Every company was just getting sold indiscriminately in this sector, including relatively, safe pipeline infrastructure companies like Crestwood. So Crestwood stock actually fell from, I believe, over $70 a share to it fell below $20 a share in the 2015 timeframe. Let's see if we can show that. So from the beginning of 2015 through the end of 2015, Crestwood stock fell from over $75 a share to less than $20 a share. I started getting interested in the sector. This is looking at the out of favor sector, right? Being a contrarian. I started looking at the sectors thinking there's got to be something in this sector that may be a little bit more resilient, a little bit safer. Sure, there's going to be a lot of like deep water drillers and things like that probably go bankrupt. We're definitely in a new regime as far as oil prices are concerned. But maybe there's some assets here that are being sold indiscriminately that are actually starting to get cheap. And I noticed, I found this company Crestwood, right, in the MLP sector. One of the things about the MLP sector was a lot of these companies were dividend paying stocks. And so there were a lot of mom and pop investors that got involved in MLPs for the dividends. Well, a lot of these MLPs
And what's an MLP for anybody that doesn't know?
It's a master limited partnership. So it's just it's a way that a company is structured. It's almost similar to kind of like a REIT, if you're familiar with real estate REITs. Yep. They put these assets into the MLP structure. They have certain tax advantages and they pay dividends to most of their investors. But some of these MLPs started cutting their dividends because they were worried about cash flow potentially declining, and they wanted to conserve their cash and not get too over levered. And so some of them started cutting dividends. Well, that meant that these stocks got sold even harder because the mom and pops who were in them were only in them for the dividends. Mm-hmm. But that's where me as a contrarian comes in. I'm like, okay, I'm thinking contrarian. There's got to be some assets in the sector that are getting oversold. I don't care so much about the dividends. I want to think about what has price appreciation potential, what's just massively oversold. The charts look ugly, so I'm thinking contrarian. I find this company Crestwood. And what I find, one of the interesting things about Crestwood is that the management team and one of the smartest private equity companies in oil and gas started buying shares of the company as it had declined from $75 a share to $20 a share. And so I see these purchases happening, and they're significant purchases. Management and the private equity company made about $100 million worth of purchases. They announced this publicly in early December 2015. They're buying shares at around, I think, the $18 to $20 range on this stock. And yet the stock continues to lose value from there. The stock actually continued to go down even after that insider purchase was announced.
So dumb money is selling,
Yep.
Mom and pop are bailing,
Yep.
smart private equity
money's
guys
buying,
and insiders are
stocks
buying.
down a ton, smart insiders buying. I'm looking, I think the assets are really interesting because they own pretty stable pipeline related assets. It's like, yeah, the companies that are producing oil and gas are probably going to see their revenues decline massively, but these pipeline companies have contracts in place with all these companies that need to move their oil and gas through the pipelines. So there's some stability there in terms of their asset base. Well, flash forward a few months later in April of 2016, and Crestwood comes out with some news and announces that there are a couple things. One, that the operations of the company is actually doing better than expected. And they're forming some joint ventures and selling some other assets to just make sure that their cash flow remains stable and that their balance sheet remains strong. And so they issue this press release about these moves at the company. and the stock actually goes up 50% in one day. So again, let's talk about kind of what happened here. So the management purchase was announced in the kind of mid to high teens level in the stock, but the stock had continued after that, after December, to sell off for like 2-3 more months. I started buying in, I think, the mid to low teens. When we talk about managed risk, remember I talked about scaling in my buys. I started buying at, I think, about $15 a share. I gave myself room to make the position bigger and do more work in the company. In February and March, this thing sold down to below $10 a share. I started buying aggressively. I actually made this about a 20% position size in my portfolio. And so that was a really compelling reward to risk.
And that's about as high as you are comfortable going, about 20%?
Exactly.
Okay.
But I was confident enough to make it a large position because of that very high reward to risk. I thought the downside was almost nothing. And I was buying like 50% below where the smart insiders were buying. And after the stock was already down like 80, 90%. And the other thing here that I did in terms of the avoiding mistakes key to making a stock grade investment is that I didn't really try to get cute about timing my buys. You know, I wasn't trying to wait for the stock to go back up to start buying. I was buying when it was going down and scaling in. And I had done the work to be more confident about the fundamentals behind the company, which helped me with that. But I wasn't trying to get cute and wait for the stock to go up. If I had done that, I would have missed this one day in April where the stock was up 50%.
Mm-hmm.
It went from $9 to, actually I think it went from, might have gone from like $12, I think, to 18 in one morning when they issued the press release, reiterating their outlook, and then also talking about doing some of those transactions that would help make sure their balance sheet stayed strong.
Nice.
So if you had been trying to be cute about waiting for the stock or waiting for some clarity on the stock, you might have missed the huge gain in the stock. Right?
Waiting for Kramer to talk about it and say, oh, this thing's up 50%.
Yeah, exactly.
Chase it.
So again, avoiding mistakes. Don't try to time things. Don't wait for the entire sector to be up 200% before you start buying this thing, right?
Yeah.
Being a contrarian, buying the out of favor stock in an out of favor sector when everyone else had been selling. Managing risk, scaling in my buys, allowing myself to buy more as the stock kept going down to silly levels. And then taking profits. I after that day, I actually took some profits off the table. I think I'd gotten my average cost down to somewhere around $9 or $10 a share. And so when it popped that 50% in one day and it was up to $18, I took a decent chunk of my position off the table, which allowed me to let the rest of the position ride. I wasn't going to make the same mistake that I made with booking. And so I let my position ride, and that stock became a multi-bagger. It went to over $30 a share, and they were still paying some dividends. So my total return was like several 100% on the position.
Beautiful.
Yeah. But taking some profit there did allow me to let the rest ride and continue to ride it for another, I think, 2 years or so. So that's kind of how I put those principles into play.
So that really, so the Crestwood play, it shows how you avoided all the common mistakes you mentioned. Mm-hmm. You were a contrarian, but you also noticed when the dumb money was getting out and the smart money was getting in.
Yep.
And then by managing risk, you were able to stay in and scale out.
That's right.
I love it.
Yeah.
I love it, man. So I guess this is really the hedge fund playbook is a culmination of all this stuff, right? Like avoiding all of the mistakes, being a contrarian, because that's where the profit is.
Yep.
Right. It's like, sure, you can catch what's popular and you might be able to ride that trend for a little bit, but the biggest gains are in the ugly stuff or the stuff that nobody wants to look at.
Yep. Going against the herd and at the right time, the right place.
Nice. Awesome, man. Well, thank you so much for being here today, guys. I hope you got a lot of value out of that. We're going to do some Q&A here in a minute. So if you guys have been writing questions, we're going to open up the chat. Before we do that, like I mentioned earlier, I was going to tell you about the community that we have at Skill Incubator that Trav is a mentor with us there. So I'll take like just a couple of minutes and tell you guys what we do. And if you are interested in joining us, we are opening some spots in our community. Before I tell you about all the stuff that you get in our community, let me first just kind of tell you who it's for and maybe more importantly, who it's not for. We're pretty picky about, we have a great community of guys and ladies that have been with us since, I started trading Bitcoin in 2013. And we like to have a core group of people that are long-term focused, that aren't looking to get rich quick or look to, turn $5,000 into $1 million in a year. Like, this is about steady compounded growth, looking for these incredible opportunities and approaching it from a professional's mindset. So if that sounds like it's what you're looking for, it's probably a good fit for you. The other person that I would say this is not a fit for is if you are deep in debt and you don't have risk capital that you can put to work in the markets and not worry about it, then this is definitely not for you. We don't want anybody going into debt to join us. I've just noticed over the years that when people trade or invest with scared money, it never works out well, because you make a lot of those common mistakes and you're prone to, basically making emotion-based decisions. And so risk capital is very important, and also just having that professional's mindset and not looking for the quick buck overnight, right? It might happen that your first month with us, we have a huge trade. It might be several months after until we have an opportunity, but our focus is in the highest growth markets, like obviously crypto, but the stock market offers such a huge opportunity. And I just see a big gap. There's a lot of stuff out there about like the short-term kind of quick fix, like day trading or, penny stocks and shit like that we've talked about, which is why I wanted Travis, who is a true professional with a track record at $1 billion hedge fund, to join us and to show us what the smart money actually does in the stock market. And so, Tony, let's go ahead and switch over to the slides, and I'll quickly tell you a little bit about what we do, and I'll give you guys an opportunity to join us for those of you that want that. And then we'll get into some Q&A. And thanks for sitting with us. I know we've been going for like 2 hours.
Sorry, I get a little winded there talking about investing.
Well, it's all good. And I know we've been having some tech issues with these slides and stuff, so we'll get that stuff dialed in. But basically, for those of you that want to invest alongside us at the Skill Incubator, we have our wealth building community. And the first thing that you get with this is our 24/7 members only chat rooms. And we have different channels. So you can see here on the slide, we do everything from stocks, cryptocurrencies, investing and personal finance, crypto mining and baking, which is ways to create passive income in the crypto markets. Also mindset, just kind of the mental side of this is so important. So this is all set up in our Discord channel. So like I said, we have different chats for the different topics.
And we're part of this too. We interact, we chat, we cover questions, everything like that. Like Chris and I and other mentors in the community are in those channels as well with you. So
absolutely. Yeah, it's a very interactive community. And like I said, we like to keep really high quality people in there. And then we also do trade alerts for stocks and cryptocurrencies, so you can see what we're investing in or what trades we're taking. But more importantly, you can learn why we're taking action. We don't want people just to blindly follow us, right? That's not what this is about. We want you guys to actually learn the thought process behind why we're doing what we're doing. And then this is an example of my last Ethereum breakout trade that I took a couple weeks ago. I map out the chart, usually show my entry, exit, risk to reward, my thesis on why I think what I'm thinking. Travis, you do something similar. You want to give a little color to that?
Yeah. So not only do I put together watch lists for the community of stocks that I think are potentially interesting, but when I actually make a trade myself, I put a pretty detailed description in of why I'm buying that stock, what I think is interesting about the company, what I think, the upside potential is, and then also how I'm sizing it in terms of, position size in my own portfolio.
Yeah.
So you can really get an understanding of, what I'm doing with that position and why.
Awesome. So again, the trade alerts are great because it's, it's day to day, like real time action, like what we're actually doing in the markets. And then to help you kind of prepare for trade alerts, right? It's one thing to wake up and go, oh, one of the mentors took an investment and here's the reason why. To help you prepare for that, we build watch lists where you can see which markets we're either planning on investing in or looking for a future possible scenario. You can understand the fundamental reasons, the technical story behind our thinking, and also just continue to be on the forefront of new and emerging markets, whether if it's in cryptos or, like in stocks, a space that not a lot of people are paying attention to. And Trav, you go into a lot of detail on your watch list. You want to talk a little bit about how you build this? Or
Yeah, I mean, like I said before, I start with a very wide funnel. There's hundreds of stocks that over time I've accumulated as part of my broader watch list. And then I narrow that down for the community into the ones that I think are potentially actionable in the next year or two. Not everyone will be actionable, but I spent a lot of time, digging into them, researching them, spending, my time picking what I think are some of the more compelling opportunities. And so then I put that on a watch list for the community. And, as you can see, I put a lot of thought and descriptions into that. And then, we continue to monitor them. And then when I actually take a position, again, I tell you why, and I tell you where I think, the targets are and how I'm sizing it and how I'm thinking about it. So you can really understand the way that I'm thinking about it.
Yep. Awesome. So also in addition to the watch list, we do weekly live market update classes. So these last anywhere from an hour to 2 hours. And basically we just pull up the charts, pull up the portfolio, analyze recent trades and investments, any upcoming opportunities or market forecasts or news events. It's just kind of a good place that a lot of our members call home. Every week we kind of get together and, look at the markets as a whole, talk about what opportunities we see. We do Q&A. And by the way, these classes are recorded. I know we've got people all around the world. So if you can't make it, or if you want to, come back after the fact and rewatch it, those are I think just very valuable for people. And so that's really what the community is about. And what we've done is I know you guys are here live with us on this masterclass today. We're going to go ahead and bundle in some of our best courses for you guys. Obviously in the community, that's like a lot of the nuts and bolts of the day-to-day action. But we also want to help you guys learn the fundamentals and the foundation of what we do. So Travis actually, after about a year or two of creating his stock investing foundations course, we decided to release this to our community for free. So because you're on the class with us today, you're going to get this as a bonus. You want to talk a little bit about what's in the course you just released, Trav?
Sure. Yeah. I mean, I spent a lot of time really trying to figure out how can I teach everyone the core concepts of stock investing that they need to know to become a great investor. And so that covers a lot of things from, how do you value a business and then figure out, the stock price that you think it's worth. And so that gives you an idea of where you buy that stock. How you calculate metrics like market cap and PE ratios and all the fundamental things that you should know as a stock market investor. Mm-hmm. I even talk about high level things like active versus passive stock investing. I go further into detail into studies about, investor behavior in the stock market and sources of edge and places, where we think about finding great investments, things like that. So it's just a lot of like nuts and bolts about what I've learned over 15 years of both, corporate finance classes, as well as actually investing as a real investor. I took all that information of, 15 years and tried to distill it into like what really matters. And here's what you need to know to give you the foundations to become a good stock investor.
I love it.
Yeah.
Yeah, man. I mean, it's so powerful. And, in addition to his stock investing course, we realized that a lot of people don't really have a strong foundation of personal finance. So the second course that you're going to get is called Maximize Your Money. So I'm going to go ahead and just pull up the camera here. It looks like the slides are a little delayed again. But the Maximize Your Money course is all about building a strong financial foundation. This goes back to everything from learning how to minimize taxes, maximizing your cash flow, and also optimizing your investment opportunities in your portfolios. I feel like if you miss that initial foundation, then you're going to leave a lot of money on the table. So that's also part of this. And then the third course something that I'm most proud of, this is kind of my baby, is the mental mastery course, which is all about the developing a strong mental game for trading and investing. Because it's one thing to know the technicals or understand how to really dive in and look at the fundamentals of a company. But if your mind and if your mindset is driven by emotions like fear and greed, your decisions and your results are ultimately going to reflect that. So this is something that I think is just so huge. We talk about how to develop a strong trading plan, and also what to do when you have a loss, right? How to handle mental things like tilt, right? For any poker players out there, how to handle when shit doesn't go your way. And also learn proper risk and money management techniques, because like Trav said, I mean, that's a huge thing that they've focused on at the hedge funds, was position sizing and risk management. And how does that tie into the mental side? So that's something that I think is really powerful. So T, you can go ahead and pull up the slide again. So we do have a exclusive masterclass offer for you guys that are with us today. So yeah, go ahead and switch that over. I wanted to make this affordable for anybody that's really serious about taking their investing and their wealth game to the next level. As I mentioned, this isn't for people that are just looking to get rich quick, but we did want to give you guys the best opportunity to get in. So for those of you that join us today, we're going to knock 50% off of your first membership payment. And we have a couple of different options. You can either do monthly or quarterly. So monthly it'd be $97 for your first month, or $247 for your first quarter. So like I said, I mean, we wanted to make this affordable for anybody that was properly capitalized and feels like they'd be a good fit in our community. If not, that's cool too. We'll jump into some Q&A here in a second. But here's the link, skillincubator.com/community. And then you'll just type in this promo code whenever you choose monthly or quarterly. Just type in half off, one word, and then that'll give you that initial discount. And then again, what you're getting is, with the community, the access to the chat rooms, the trade alerts for stocks and cryptos, the weekly update classes, and then also the 3 bonus courses. So
It's a crazy amount of value.
Yeah. I mean, we've sold each one of these courses individually for like $500. So we just wanted to make it a really stupid no-brainer offer for you guys. So I think we can actually go ahead and pop up a link here in the chat. And then for you guys that are getting registered, go ahead and do that. And then I'm going to open up the Q&A here in a second. And we can jump into some questions. So let's do this. All right. So I just turned the Q&A on. So Trav, I'll kind of push these out to you as we
hit me with it.
Hit them. And then I'm going to pop up. Let's see. Awesome. Yeah, looks like we're good to go. So Zane asks, how much time and effort do you spend considering major market trends like the next possible market downturn or crisis?
It's a good question. Yeah, I spend a decent amount of time every week looking at macroeconomic data. And, I've over the last, 2 decades or so have figured out, kind of what things matter and what things don't. So, there's a couple indicators that I look at and a couple things that I follow. I spend a lot of time during earnings season actually reading through conference calls, especially companies that have a really tight coupling to the consumer and to the economy as a whole. So I don't use that to drive my investment decision-making necessarily, but I do keep an eye on the macro environment as well as the valuation level of the stock indices. So I do use that to kind of think about position sizing and aggressiveness of how I'm entering and exiting positions at times. I probably spend, about 5 hours a week on that side. And the rest of the time, probably spend a good, 40, 50 hours a week looking specifically at specific stocks and companies and doing like deep fundamental research on the companies themselves. So I'd say only about, 10% of my time is spent on looking at macroeconomic data, but I do spend some time there. And I do think it's important as a stock investor to at least have an understanding of how those drive the equity market as a whole.
Yeah. And I think, I mean, I know you're not all about timing, but like on Christmas Eve of last year, I know the markets were diving hard, and that was kind of a unique situation, right? Where there was like a unique timing opportunity. But I think that's an example of like more of a broad market type add-on to the analysis that you would do just with like, instead of just individual fundamental analysis, right?
Yeah, that's right.
Cool. So Bernie asked, the stock market has been in a bull market since 2009. When do you think we will see a major pullback?
Yeah, it's interesting actually. So when you look at, valuation levels of the market, they're not at absurd levels. We're nowhere near where we were, let's say, in the dot-com bubble. So I do think the reward to risk has changed somewhat in the near term. It looks like, the economy is relatively weak. And that's true domestically and globally. The economy is relatively weak, and there are some risks out there, geopolitical as well as, things like trade wars and things like that, that could tilt the economy into more of a downward recessionary environment.
Yep.
So I do think the reward to risk is, not super compelling from a market-wide standpoint. But I also don't think it's, I'm not someone who's like looking for a crash in the near term. So I'm of the mind that you just have to be very careful about your positioning here. Like I wouldn't be too overextended in stocks in general. But I am looking for one-off opportunities, and I am still entering positions. I'm just not being super, super aggressive about making those large, because I do think there's a decent chance we'll have the opportunity to make those positions bigger. So I would say I'm cautiously optimistic. You can't let, at any point in any year in the last 10 years, people would have told you, and headlines would have told you that, the market's at new highs, there's got to be a correction coming around the corner. The market's at, whatever levels, and we haven't had a correction in X amount of time, so, but you would have missed out on further and further gains, especially in specific stocks. So, again, you can't rely on news headlines to drive you in and out of the market. You still have to actually look for good companies trading at reasonable prices.
And yeah, I just pulled up the chart. So this was the, the 20% dip in the S&P that we had. So this was the Christmas Eve. So this is, I think you got Roku and a few others that you bought at this point.
Yeah. NVIDIA, Apple, Facebook. I made some of my existing other positions larger as well. But yeah, I mean, you can even see some of my tweets from the 24th. I was telling friends and family who were freaking out. I was like, look, now is the time when you want to be buying. The market has corrected 20% and the economy still looks, pretty solid. We're not seeing any financial dislocations with the banks like we saw in the last recession. That's one of the things that a lot of people are getting caught up on lately, is that they remember that last recession was so deep and so bad. Well, that was a particularly bad one because we had a banking system crisis.
Yep.
Our next recession probably won't look as much like that. It will be similar, but it'll certainly be different in its own way.
Yep.
So I'm not saying a recession won't happen in the next couple of years, but I think it'll be different than what a lot of people are expecting. So I think when a market's down 20% in 2 or 3 months, you have to start looking for good opportunities, especially with specific companies that are doing quite well, regardless of a recession.
Yeah. But even if a recession does hit, I mean, that's just going to bring a lot of the tech stocks back to earth.
Yep.
Maybe make some of what are discounted right now even deeperly discounted.
Exactly. I'm looking kind of at a bifurcated market here. There are sectors in the market that are already trading at pretty distressed levels, expecting a recession.
Yeah.
And of course, you got tech on the other end that's at very, very high valuations. So we've got a bifurcated market in a lot of ways. So there's a lot of opportunities even now, even near all-time highs. And I think if we do get a market correction like we saw last December, then we're going to have some wildly, great risk-reward situations in certain stocks.
Nice.
So I actually get excited about the market correcting. And again, I just use, the market's levels and the valuation of the market as a whole as kind of this secondary backdrop to what I'm doing with individual stocks. I use it as a way to inform my aggressiveness.
Nice. Marco says, you say studies show that stocks are the best performing asset. What about crypto?
So that's a great question.
That is a great question.
Because we don't have enough data on crypto. That's why crypto was not included in that study that I mentioned, the rate of return on everything, because we only have data going back about 10 years on crypto now. Mm-hmm. Now, I do think crypto is certainly an interesting asset class. I've owned crypto in my portfolio for a couple years. And, I think there's a lot of interesting things about crypto. It may be the best performing asset class over the next decade. We don't know.
Yeah.
But certainly historically, we don't have enough data against crypto to really determine if it's a good asset class long term yet.
Yeah. I mean, to me, that's the biggest differentiator, right? Is like, and I know a lot of crypto people love to hate on the stock market. And I'm like, listen, I'm an early adopter of Bitcoin. I made a life-changing amount of money in crypto. But I still see the value of the stock market as a long-term thing. What is the stock market? If you're bullish on the stock market long-term, that means you are bullish on humanity innovating and building products and services that other people want.
Yep.
I'm in that camp. I'm not in the perma bear, the world's going to hell in a handbasket, like things are going to just crash and die forever. Are we going to have recessions? Are we going to have moments of panic? For sure.
Absolutely.
And those are opportunities, right? That doesn't mean that the world is like falling apart. I'm still bullish on crypto. We've been accumulating the past few months after the last market cycle, right? But I think, Trav, what you were saying is like looking at 100+ years of data, that's the asset class that has that time frame that you can really look at and judge against real estate or other asset classes that have been around, even gold.
Yeah, absolutely. And I would never suggest to someone that they should only be in one asset class. I'm involved in some real estate. I'm involved in stocks, obviously, very significantly because that's my bread and butter. I have some crypto, and I think having some diversification across asset classes definitely makes sense as well. And the cool thing is with our community, you have one of the best mentors ever in crypto, and you have, an okay mentor in stocks too.
Yeah, man, we do it all. Why be a one-trick pony?
Exactly.
Chris, it looks like there's a separate area for Q&A in the chat.
Yeah. So there are two sections here. I want to make sure we don't miss any questions. Let's hit those. Okay, so I'm gonna mess this up, but Diavadas. How much money do you think approximately is needed to start trading stocks?
Well, the cool thing about both crypto and stocks is that you need a relatively small amount of money to start investing. I mean, a couple $100 even can get you started with a basic brokerage account in stocks or crypto. Now, again, like Chris mentioned, if you've got, a lot of other things that you need to do first before you invest in stocks, then you should do that. You shouldn't be trying to get involved in stocks if you still need an emergency fund or something like that, right? If you still need to build up a little bit of savings, then you should do that first. But if you have that taken care of, you can get started in stocks with a relatively small amount of capital.
Yeah. And we talk about that in the Maximize Your Money course, like, just how to think about things practically. And you can open up a Robinhood account with a couple $100, and like, even if you are still building the other foundational pieces of your financial house, getting into the stock market and at least learning about it and getting your feet wet, I think is a smart idea. Now, obviously, if you have a financial advisor, talk to them and let them look at your personal situation to figure out what that looks like. But the one thing I think I would guard against or suggest you don't do is like leverage up or like go all in or like put all the money you have into one stock or one crypto, right? You could get lucky, but probabilities aren't in your favor.
Yeah. Don't end up on Bag Holder or Wall Street Bets.
Yeah. Let's see here. So,
and we laugh, but some of those stories are heartbreaking. Marriages are destroyed. Houses are lost. People have real consequences when they do really dumb things like that.
Yeah. Thanks, Kodzo. Thanks for the feedback. Where do you guys see yourselves in 10 years?
Oh, wow. That's deep.
That is deep. I have an answer. Do you have an answer?
I mean, yes. I would like to hear yours though first.
So I made a decision before I made a lot of money in crypto that it doesn't matter if I'm rich or poor. I want to do the same thing, which is wake up every day and learn something,
Mm-hmm.
work towards growing my wealth. And again, it doesn't matter if I, was like broke back before the financial crisis or a multimillionaire. Like, I want to do, like, my days aren't going to look dramatically different. So I like teaching. I like having a community of people. Obviously, we like doing startup stuff. I'm just obsessed with like building value. Is Tony cracking a beer over there?
Hey, it's 5 o'clock somewhere.
Sparkling water. Okay. Yeah, no, man, I don't know. I like doing videos. I like having the community, and I like investing and learning stuff.
Yeah.
And I see that framework is like, I want to carry that for the rest of my life or as long as I can.
Yeah, that's awesome.
Yeah.
I mean, that's not too dissimilar from me. I mean, my whole thing is I want to be able to have control over my own time. I want to be able to do the things that I want to do and have that financial freedom and flexibility to do that, which I've, thankfully been able to achieve. And hopefully 10 years from now, that's also the case. Want to be involved in education. Education is sort of like the foundation of everything, right?
Yeah.
Like a lot of the problems in society are solved by having the right foundations of education. And so being a part of that and being able to give back and teach other people, I wish I had, I did have great teachers along the way, but I wish I had more of them. I wish I had mentors that could have guided me a little closer and a little better. So I want to be doing that. And I'll definitely be investing. Like, I just want to keep investing and finding great stocks. And, I would love to be mentioned among one of the greats one day, but, that may or may not happen, but
Hey, either way, man, do your own thing.
I just love the journey, man. I love the markets. They're exciting. They get me up every day excited. So
yeah. Awesome. Next question, are you also looking at other regions outside of the US, for example, emerging markets like Latin America and Africa? How do you invest there? ETF, MSCI, stuff like that?
Yeah, so there are a lot of ways. Africa is actually a little bit more difficult, but there are public stock markets in most of those countries and most of those regions, like Latin America. I've made several investments in Brazilian stocks, Argentinian stocks. I have one now that's in Latin America that I think is pretty interesting.
Did you guys do something in Korea?
Yeah, did quite a bit in Korea and Asia. So Korea, Japan, China's a little bit harder of a market.
Yeah.
So I'd say there's a few countries and a few regions that are difficult to get access to public market stocks.
Yeah.
Places like China. Although a lot of Chinese companies have listed in the US, so you can actually get access to some fast growing Chinese companies through the US market, which we've done, and I have a couple of Chinese positions.
Those are super risky.
Well, yeah, yes
Kinda.
and no. I mean, companies like Ctrip and Baidu and things like that that I've invested in are large Chinese companies. Certainly, there's some risk to them, but pretty stable.
Oh yeah,
larger
Baidu.
companies.
Yeah, of course. The
Yeah.
staples, yeah.
The
big
large
ones.
Chinese companies listed in the U.S. So yeah, I mean, I try to look globally, but again, there are certain countries where there just aren't as many public stocks trading.
Well,
so like Africa, for instance, I have
Yeah.
a friend who manages a hedge fund that invests in companies in Africa. Most of those investments are private investments, but you could invest in his hedge fund, to access the returns of that market. So
Is he a part of Nexion?
yes,
I think I met him.
yeah, I think you met him. Yeah. So
Yeah, this is the Nifty 50, just showing. I don't know if you guys how well you can see this, but just the growth of India. So this is a ETF that I think carries what's the fee? Maybe half a percent. Sounds about right.
That sounds
50
about
basis
right.
points.
yeah, it's a little more difficult to get access to some of the stuff in India sometimes.
Yeah.
And so in some places you need a local broker, like Korea is still that way in a lot of cases.
hmm
But other places, Singapore, Hong Kong, Japan, like there are a lot of public stocks that you can trade over public exchanges through even some U.S. brokers. Like I use Interactive Brokers, and they give me access to a lot of different markets, which is really nice.
Nice.
So
Marco asks, is Tesla a tech or a car company? What do you think about the short squeeze out after the next quarterly report?
Oh man, Tesla could be its own webinar, right? I have a lot of thoughts on Tesla. The financials, first of all, make it clear that it's an automobile company. It's not a tech company. There are certainly some technology components to Tesla. There are technology components in every car now. But if you look at the financials and what Tesla actually sells in terms of products, what makes up their revenue, it is a car company. Let's not kid ourselves. And Tesla's an interesting one. It's a battleground stock. I've actually avoided Tesla on both the long and the short side because I think there's too much brain damage there. There's too much time invested in something that I think is probably difficult for most investors to really get an edge in. And I'm not particularly fond of the CEO.
So would you say this is one of those stocks that is like, it's obviously one of the most talked about stocks,
Yes.
but it's also one that it's like, why try to trade this
Yeah.
when, like you said, everybody's thinking about it,
Yeah.
everybody's eyeballs are on it, everybody's fighting over it, when you can go and find something that's either severely underappreciated or just not paid attention to?
Yeah. If you spent your time focusing on Tesla, you've wasted 3 years of your life or 2.5 years of your life because it's traded in a pretty much the same range for the last couple of years, right?
Yeah.
And meanwhile, there's like 1,000 other stocks that have gone up, 100% or more, right? So, yeah, I mean, you got to be careful. This goes back to one of those keys in my presentation about, just not being a financial news junkie, because Tesla is in the news almost every day.
Yeah.
And it's going to take up your time and energy and focus when
Yep.
you should be spending it elsewhere. And
Cool.
they're doing some cool things. Don't get me wrong. I think what they've done is very interesting. They've been the catalyst for the auto industry as a whole starting to move towards electrification of their vehicles. That's a very, very important thing. They obviously have some cool cars. They obviously also have a lot of other problems with that company, and they've mismanaged it in a lot of ways.
Yeah.
But
I'm rooting for Elon.
I'm
I'm
rooting for Tesla.
Yeah.
I'm
Okay.
not-
I see that.
I used to be a huge fan of Elon, by the way. Read his biography, was very fascinated by him and what he was doing with all his companies. I think he's done some things, and I think he's got some issues he needs to work through. But I hope that Tesla survives and ends up being another great brand and company one day, and certainly SpaceX and some of the others. But
Yep. No doubt he's a genius. It's just, is he a good CEO?
right.
Right. Is he a good public company CEO? How do I invest in the U.S. markets if I live in Europe?
Yeah, so there are certain brokers in Europe that do allow you to invest in U.S. companies. DEGIRO is one of them. I know there are others. So it's really about getting access to the right broker that gives you access to U.S. markets. So again, there's a few, but DEGIRO is probably one of the bigger ones, and I have a list somewhere that I give to our community that lists a lot of the major brokers, stock brokers in different markets.
I think most countries around the world, unless there's a sanction, like you can pretty much participate in the U.S. markets.
Mm-hmm.
Here's a question for me. How much of your focus goes into U.S. stocks versus international stocks?
I'm still pretty U.S. focused, especially lately. I think I've probably been like 80 or 90% U.S. focused.
Okay.
But when the opportunities dry up in the U.S., as they sometimes do during certain periods of time, I will start to look more internationally.
Mm-hmm.
And when there's dislocations in certain international markets that I follow, then I'll start looking more at stocks in those markets.
Gotcha.
Yeah.
Gotcha. Yeah. What do they call it? The home country bias, right?
Yeah.
And, I don't know. What do you think are some of the most emerging or interesting areas that could be like over the next decade or two outside the U.S.?
Well, you mentioned India. I still think that market has huge potential. Brazil's another one. Brazil has a new president that got a lot of people excited because he's very pro-business. And so, maybe things will get moving in the right direction there. So I think South America in general, Argentina's been through so much, and that may not get that much better, but there's just so much potential there. So that's an interesting one. Asia continues to be interesting just because a lot of the valuations are still very cheap.
Mm-hmm.
And obviously there's still a lot of population growth there and a lot of development happening and urbanization happening. So those are areas I'm definitely excited about, but yeah.
You've got India middle class just booming right now.
Yep.
Cool. Well, guys, we've been going for like 2.5 hours, which is a lot longer than I was expecting to go. Thank you for sticking with us.
Thank you all.
Yeah. Thanks to Trav for taking the time, and Tony for manning our Frankenstein of a setup.
Thanks, T.
We'll get the tech issues figured out for next time, but Yeah, this is always fun, guys. Hopefully we'll be able to do more of these this year now that we have the studio going. And yeah, so if you have any other questions, feel free to reach out to us, support@skillincubator.com. For those of you that want to join our community, you should see something popped up on the screen where you can just click it and it'll take you to the page. And again, half off is the promo code. Tony, why don't we pull up the screen one more time, just so you guys can see that?
Yeah, we'd love to have some great investors join the community and be part of our community.
Yep. Yeah. Again, if you're long-term focused, if you have risk capital, if you like just us and how we are, we'd love to have you part of the community. We have a lot of really cool people. Some people that have been with us for a long time that have made life-changing amounts of money in crypto. Some people that are like brand new and just getting their feet wet.
From all over the world, lots of different countries represented.
Absolutely.
It's really cool.
So cool. So yeah, we'll leave this up and yeah, thank you guys so much for coming and we'll
Thanks,
see you next
everyone.
time.